on to that, the big issue there in talking about these prices. Do you feel like food is we've got fundamental problems in demand, and I don't I don't think anybody feels like food. We've got that long-term problems in food demand, but we have issues as it relates to supply chain. We've got issues related to labor. We've got issues related to these production facilities. And after as we start to normalize there, we're starting to see a return to prices, more normalized prices.
Brian, it's Heidi Chung here. Just a quick question. Do you think that the U.S. government now is doing enough for the agricultural sector? And if not, what more can the government do here?
Yeah, before all of this, net farm income was supposed to be about $92 billion this year, and there's estimates that losses up to this point are somewhere between a third to half of that. The CARES Act came through with about $19 billion. That comes through may have upwards of $50 billion in there, but I think the long and the short of it is that no, not yet. Liquidity is half of what it was at the beginning of the decade. So I think it's important that we focus, the government focus on the farmers and what they're looking at, and depending upon what weather happens with weather this year and how this thing continues to roll out, we need to keep our eye on that. We certainly don't want this turning into a long-term food supply issue.
Compared $19 billion in government funding that will be supposedly coming to farmers on that front. We've heard up the way that he's the friendliest president to farmers since all the way back to Abraham Lincoln. Would push back on that and say, look, well, you're kind of just off-putting the pain that you impacted on farmers because trade deal problems there. What would you say has been his impact on the farming industry here over the last 4 years and what we're seeing play out right now?
Yeah, I think farmers, not all, but a large number of farmers supported as it related to his election. I think a number of them probably support him as it related to his strategy toward China, and from the agricultural community, that it was they had lost enough battles, they were ready for someone to fight a war. I think now was it worth it, right? In the last 20 years, it's become such a global market, and these local communities sometimes don't feel like the policies being espoused in Washington and elsewhere are representing them. So it'd be interesting to see how that plays out politically, and I'm not going to opine on
all right. Well,
the
there you
full
go.
extent of your questions, Zach. Thank you.
Yeah, well, I appreciate what you are able to say, Brian. I appreciate that. Brian Philpott, Ag America Lending CEO. Appreciate the time, sir.
Appreciate it.
All right, we're going to take a quick break here. On the other side, digging into that response out of Washington, D.C. We'll chat with the representative from the state of Colorado. Representative Ed Perlmutter joins us for more on D.C.'s response to the coronavirus crisis, as well as the new push to get a Safe Banking Act and the way that cannabis companies are trying to access the bat right after this.
The idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every
Welcome back to live market coverage here on Yahoo Finance. I'm Zach Guzman. Right now we have stocks trading off in the red. The NASDAQ off more than 0.5%. We'll keep you up to date on those moves right now. But we are discussing an interesting kernel in the HEROES Act, the Democratic pushed bill, $3 trillion worth of stimulus bill that's being pushed through there. Not all of it might be agreed to by Republicans to get it into law, but there are kernels that are gaining some steam, and we want to focus on one of those right now on the cannabis front. You may remember the Safe Banking Act that passed back in September of last year that would give cannabis companies access to banking and shift them away from being a cash-only business. The bill was introduced by Colorado Representative Ed Perlmutter, who joins us now on the show. And Congressman, it's interesting to see a bill get passed twice, but that's what we got going on here in the House. What do you think is the main push? Because we did hear from 34 bipartisan attorneys general backing this as now the time to get this done to help cannabis companies shift away from having to be cash only. So what do you make of the renewed push and the way that this is now gaining more attention yet again?
Well, it was, one piece of a very big bill. Clearly was a bipartisan piece because when we passed it back in September, it was 321 to 103, like 230 Democrats, 91 Republicans in favor of it. So clearly this was a bipartisan measure. And at that time, the focus really was on public safety and the fact that so much cash is, piled up that it really puts people in jeopardy for assault and battery, for robbery, and those kinds of things. But now there's this added element of the potential transmission of the virus on cash. And then you add to that, the cannabis industry has some 243,000 employees, 28,000 businesses across the country. It's essential business in 28 states, but it can't access the banking system, and it can't get any paycheck protection loans. So that's why we really put it in there, both from an employment standpoint as well as a safety standpoint.
I do like seizing the opportunity here when we look at it, and obviously there's some tax revenue incentives here. As we've always seen this bill as kind of an icebreaker, at least that's the way you phrased it. What you're going to need to overcome is really getting Senate Republicans on board, and it seems like they have a team list of policies that Democrats want to see put through. But as you noted, you had support in the House from Republicans on this. So what do you make of the chances for it to actually move forward and get passed now?
Well, and we have support of Democrats and Republicans in the Senate. Jeff Merkley and Michael is championing it. So, I think it has a chance. McConnell, picked it out, could add money to the federal treasury as opposed to take away. You talked about taxes. But I think that the Senate is going to accept a number of things that are in the HEROES Act, especially the funding for state and local governments and school districts, because they're going to be in such dire shape because of the fall off in tax revenue across the country. And if we don't do something about that, firefighters and law enforcement and workers are going to be laid off just at the worst time possible. So there are big chunks that I know the Senate is going to have to do something about.
Yeah, I want to talk about this before we move on, though. I want to hold you to
effort to get this done, and it would be done in a bipartisan way. And I think the White House and certainly Secretary Mnuchin, they're familiar with this, and we've been talking to them about it for quite some time. So I'd say 50-50.
All right, interesting odds there. Obviously, it's not a lot of chances that you get at trying to get through twice, but interesting to see. When we talk about the other,
no, but Zach, that bill is sitting there twice now. So the standalone bill is in the banking committee, and the part that's in HEROES is sort of on the floor of the Senate. So the bill is sitting in the Senate in two forms.
When we look at the other pieces, though, the Republicans might be amenable to accepting here. You've got the next round of stimulus checks. That's a piece of the HEROES Act. You've got Secretary Mnuchin talking about the fix to PPP. Not sure if that would be a standalone or separate thing here, but what do you look at in terms of what you're seeing bipartisan support for in terms of the pieces of the HEROES Act that might be the best odds to get through?
Well, I'd say the two that are sort of front in my mind, and I think have bipartisan support. One would be assistance to state and local governments and school districts, just because they're going to be in such bad shape if some backfilling of their tax revenue isn't found and passed to them. Second, you mentioned some fixes to the Paycheck Protection Program. I think that is something that will get done and has strong bipartisan support, so that there's a little more flexibility. For instance, in Colorado, restaurants can't open yet. Now, they may be able to open for outdoor seating. They're doing takeout right now, but they can't open. So the PPP doesn't really work for them because they can't put their employees to work. They need more flexibility. So in the HEROES Act, that flexibility of using that 8 weeks of paycheck protection would extend to the end of the year instead of just to the end of June. Or July 31st, whatever it is. But it gives them more flexibility. And I think that will pass. I think there is strong desire to continue to provide funding for testing and make sure people get tested, and to continue to fund vaccine development.
Yeah, and I mean, we have seen, it does seem like from Senator Rubio as well as Secretary Mnuchin, it does seem to be a push on that PPP front and extending it. But I want to thank you for taking the time. Exciting times to see your baby get another chance at life here. Congressman Ed Perlmutter, appreciate you chatting with us.
All right, thanks, Zach. I'll talk to you later.
All right, be well. We're going to take a quick break here. Before we let you go, though, I want to highlight the fact that if this does get through, interesting things happening on the cannabis front. We'll be chatting with the CEO of Canadian cannabis company Aurora Cannabis. Michael Singer will join us tomorrow to chat the new deal that he made to get access to the U.S. CBD market, scooping up one of the companies we have here. We'll chat what is on the timeline in getting that out and why he sees it as now the time to strike in buying Reliva. We'll have that interview tomorrow. Going to take a quick break here. Other side, a return to the IPO window with SelectQuote jumping off to about a 40% spike in its debut of trading on the New York Stock Exchange. We'll chat with the CFO of that company on why the time is now and why other companies might follow. Much more on that front right after this. still have the NASDAQ off by about exchange. Right now, shares, select quote, Raphael Sadun, choosing to approach the IPO.
5 years to help customers protect their most valuable assets, their family, their health, and their and that's 60 million Medicare beneficiaries.
I mean, you talk about
we leverage customers and carriers happy with our distribution model and have actually been looking to partner with us. The amount of distribution that goes through players like ourselves, and especially during this post-COVID-19 environment where, a lot of these insurance products historically used to be sold with brokers across the kitchen table. Obviously, people can't get into people's homes right now. And so we've always sold over the phone with sort of an inside sales professional career agent. And we think that that's going to be an evolving consumer preference going forward, even more so after COVID-19.
All right. Well, investors clearly on day one of trading buying that thesis. I want to thank you, the CFO of SelectQuote, Raphael Sadun, for taking the time. Appreciate it, sir.
Zach, pleasure to be with you.
All right. We'll take a break here. On the other side, discussing reopening plans at Disney as we look at that, as well as an interesting shakeup in the executive ranks over at the happiest place on earth. We'll be discussing that after the break, as well as a new survey looking into the way that Americans might still be planning on traveling, just not necessarily in the air. Much more coverage here on Yahoo Finance right after this. Welcome back to live market coverage here on Yahoo Finance. I'm Zach Guzman, and right now we have stocks maintaining their losses today. The NASDAQ off by about 0.75%. But right now we're discussing the return to normalcy for one of the most popular travel destinations out there, of course, that being Disneyland's parks in Disneyland and Disney World, offering updates in terms of when they plan and how they plan to reopen those parks. Of course, they recently reopened Shanghai Disney, which sold out its first 2 weeks after reopening, though they did have, of course, notable ticks down in terms of how many people they would be allowing back into their parks. Also, interestingly, the company earlier this week announcing the departure of one of its most watched executives as he was controlling the streaming business over there at Disney, jumping ship to go lead the quickly growing social media app TikTok. So our next guest, Kelly O'Grady, is .LA's chief host and correspondent, and also a former Disney senior analyst in corporate strategy. Kelly, good to see you again. Last time we chatted, we talked about how important parks were. Obviously, any return to normalcy will be welcomed by investors. Right now, we are seeing shares give back a little bit of the gains we saw yesterday. But what's your take on how important the parks do constitute still, even though a lot of the focus is on streaming, still matter for them?
I mean, Parks is hugely important for the company because, yes, it has all its IP, it has its studio, it has Disney Plus. That's where people go to really interact with these characters and these stories, and it's where families live out their dreams that they've saved so much for. The Parks is really where you're able to monetize all of their core assets. From the studios and such, and also it's a very fast-growing business unit for them, and then it also acts as a cash cow for a Disney Plus, which, as successful, is still losing money.
Yeah, that's important to keep in mind there. Of course, they didn't necessarily give a hard date in terms of when these parks would get back to normal, just highlighting the health concerns and how some attraction streaming portion, though, of the business, since it has been top of mind for a lot of investors, and as you noted, still doesn't make money. An interesting shakeup in terms of who will be leading that. When you talk about Mayer resigning earlier this week to become the CEO of TikTok, stepping into that role will be Rebecca Campbell, his successor, who was there in terms of building out Disney Plus from the early days. So what's your take on that, since a lot of analysts pursue here, not necessarily indicative of struggles within Disney Plus?
Yeah, I mean, I think the appointment of Kevin Mayer as CEO of TikTok and COO of parent company ByteDance is a really interesting one. I used to work for him. He's an incredible strategist, and I think it's showing that TikTok is really starting to blur the lines between being a tech and a media company. It's something that we see a lot at .LA. We're a digital media company that covers this hotbed of tech and startup company, but we're also in Hollywood. And so you're really seeing companies. It's interesting. She was a very well-liked, very well-respected executive at the company. She's also one of Peck, new CEO, his guard that he's installed at the top of a couple of the different business units there. Three things that come to mind for me that make this interesting. One, I think it's a huge optic win for Disney. Installing a woman at the top there. There aren't many women that are running. That her background is a bit analog, right? She used to run the local news stations, and so that's a bit of a strange one, I think, for us over at .LA and also the street. And seeing her start to take the crown jewel, the very tech forward part of the business for Disney. That being said, something that I think we've seen Disney do a lot is that the executives that they're grooming, they like to get experience in all different business units. And so she recently, the past couple of years, did a stint as president of Disneyland Resort and was also in charge of EMEA operations and did oversee the launch of Disney Plus there. So this might be an indication that we're going to see a lot more from her in the future. But when it comes to Disney Plus and heading up the streaming piece, Kevin really was the architect and the mastermind behind it. So he's laid the plans. And what Rebecca needs to do now is make sure that the ship stays the course and stays upright.
Yeah, at least highlighting one of the notes that we got after the news broke. Bank of America coming out in support of Rebecca Campbell in that role, noting 23 years at Disney and the way that she's been able to run things so far, does not expect, at least at Bank of America's eyes, does not expect to change the trajectory of it so far. But want to thank you for joining us, as always, Kelly Grady, .LA chief host and correspondent. Appreciate you taking the time.
Thanks, Zach.
As we're talking about destinations for travel and a lot of Americans out there, of course, Disneyland always went on the top of the list for a lot of kids out there. But when we think about the fact that we are still in a pandemic situation here with coronavirus cases still being watched closely, an interesting new survey is out from the Points Guy looking at the way that Americans might not necessarily be excited right now to travel. A new poll showing that only about 31% of Americans would consider taking a vacation.
Opening up in early June. But it's clear, Americans are fearful of travel by airplane until there's a vaccine. I think 40% of our respondents said that they're not going to get on a plane until there's a vaccine. And not to travel interstate and on road trips. But that may not make a whole lot of sense considering air travel is historically, and I think the airlines and airports are doing a ton to reduce the risk of transmission, probably a lot more than rest stops. So I think, there's still just so many unknowns, but it's clear Americans Most are not.
So within sort of 20 years from now, we will.
I don't think so. Listen, I hear some groans.
And also,
listen, I heard a couple of groans. 1.3 million people die from car crashes every year. 1.3 million people die from car crashes every year. That doesn't count an estimated 20 to 50 million people that are injured. Okay, this is actually a public safety issue. If you look at cars, 96% of cars, 96% of time, cars are sitting there not being used. It's a huge amount of pollution that's caused by these cars being in the road, and a huge amount of wasted time. So the safety is there. Electrification is absolutely key, and sharing these platforms is going to allow us to be much safer and also put our assets where they add value.
Every person arriving, you'll still get to go to your hotel until you get the results. If you do have the virus, you have to quarantine, but I think it's, outdoorsy type vacations are going to be the trend this summer.
The interesting other trend that your guys' report highlighted is one that I think was captured in a lot of memes at the end of things being open, which was, of course, drunk millennials on the beachfront properties out there. And when you looked into the age demographics of Americans that say that they would be able to travel, safe to travel right now, it does seem like the younger Americans out there are still the ones who are most eager to get back in the air.
Yeah, for sure. And it's interesting, there's just today, the CDC came out with guidance, like so much of what we knew, I was on the news in March saying, oh, you don't need to travel with the mask. The CDC says that you don't have to. Now they're like, you do. And the CDC today came out with that actually the virus doesn't really spread that much on surfaces like packages and groceries and on airplane seats. So I think people's attitudes will change once we get the actual picture of the transmissibility. And certainly young people, when you look at the pure numbers, most young people have nothing to worry about with the virus. I myself had it. I've tested twice now for the antibodies, and I had maybe what was the equivalent of a cold and scratchy throat and upset tummy. So certainly the virus is hurting a lot of people. I don't want to minimize it, but I definitely think in the different trend groups, different age groups, there will be much different, attitudes on travel.
Yeah, and when you look at that, I mean, what's the overall takeaway then when we think about, we heard anecdotal reports when we were first starting the lockdown is that, now it's going to be super cheap out there to travel. It wasn't necessarily the case when people actually went to buy tickets. So I wonder how much that's impacting maybe some of these destinations when you look at prices, if you might have younger Americans traveling and going to some of these destinations compared to others.
Well, I'll be honest. I mean, flights are really cheap. Iceland was $350 round trip and coach, like $800 in business class. I think I'm going to go to Iceland too when it opens, in the name of journalism. I've got to get out there and see. But I mean, to me, it's a once in a lifetime opportunity. Iceland is historically overcrowded, and I'm going to go, go into the Blue Lagoon, which you usually can't even get a reservation to, but going when no one's there. And I'm going to do scuba diving, and all of the scuba sites are offering 30% off. And the hotels are also offering really cheap rates and full cancellation. So there are definitely deals out there for those who have the appetite to travel. I think it's going to be a great summer to travel because it'll be, you'll never see Mykonos again with just, a moderate amount of people. But, Greece is the big question mark. They just said today, July 1. But I think what a lot of Americans need to know is we may not be included. A lot of countries are saying, yeah, we're opening up, but UK, Brazil, America, like we still don't want you. So our powerful passport may not be so powerful in the years after this until there's a vaccine.
Yeah, and it's all right as long as you're all right with whatever taglines might come from wearing a mask out there. But Brian Kelly, founder and CEO of The Points Guy, I appreciate you joining us as always, man. Be well.
Thanks for having me.
All right, we're going to take a quick break here on the other side, jumping into the way that Taco Bell is continuing its hiring surge, why they plan to hire more than 30,000 workers as we hit record unemployment levels. More on that right after this. Welcome back to live coverage here on Yahoo Finance. We've been highlighting quite a few of companies out there that have had the unfortunate decision to make in laying off a lot of their workers. But one restaurant, namely Taco Bell, is looking into a surge of hiring. And for more on that, I want to get to Yahoo Finance's Heidi Chung, who has the details. Heidi?
Hey, Zach. Yeah, so I brought you the bad news when it comes to U.S. employment earlier in the show. Well, now I have some good news. Like you mentioned, fast food chain Taco Bell announced today that it will be hiring 30,000 workers during the summer. And of course, the timing of that is very interesting, right? We're at record unemployment, but this company looking to really ramp up hiring here. The whole point of this, though, is because they really need to ensure a smooth operation when it comes to drive-through, delivery, and curbside pickup, because that is a lot of what Taco Bell's business is focusing on right now. So the company, along with its franchisees, will be hiring both full-time and part-time employees at all levels of the company. Also, this company has created new roles that have been created to accommodate a shift in operations in response to this global pandemic. The company saying in a statement today that, quote, during these tough times, we want job seekers to know that we're hiring and we are safe. So a lot like the other restaurants in this industry, Taco Bell had to shut down its dining rooms here in the US in mid-March and has been relying solely on drive-through pickup and mobile orders. But we have to mention that fast food has been faring quite well amid these tough and challenging times, because a lot of their business was already positioned to rely on drive-through. Specifically, Taco Bell brings in about 70% of its sales from drive-through alone. So as you can imagine, they have been able to do fairly well. But that being said, this hiring also speaks to the fact that this company is probably also seeing a surge in demand. We heard the company's parent company, I should say, Yum Brands, out with its earnings report in late April. And even though it got hit hard during the beginning of the pandemic here in the US, sales have started to stabilize somewhat and have been improving over the past couple of weeks. So certainly finally some good news on the employment front in the US, 30,000 being hired by Taco Bell, Zach.
Yeah, it's a good job if that's the one you're going for. I suppose it's all relative depending on what job you may have lost in the downturn. But again, one of those restaurants that has been able to keep things together on the delivery front, as well as just foot traffic there, the drive-through as well. But Heidi Chung, appreciate you bringing us that update as always. Before we wrap things up, 1 p.m. hour, just another last look at the market action we're seeing right now. All three major indices remain in the red, giving back a little bit of the momentum that they've been building so far. The NASDAQ off a little over more than 0.5%. Much more coming up, though, in the 2 p.m. hour. Stay tuned to Yahoo Finance, as Fed Chair Jay Powell will be providing opening remarks at a Fed Listens event just a few minutes from now. Much more coming your way. Stay tuned. Much more Yahoo Finance coverage right after this.
Welcome into the ticker here on Yahoo Finance. I'm Shauna Smith. The stocks are in the red today as investors digest the latest data that we got on the jobs front. Another 2.4 million Americans filing for first-time jobless claims this week. And taking a look at the market, we are seeing this downward move here across all of the major averages. The Dow and S&P both in the red. The Dow off just only 62 points. S&P off just around 0.6%, and the NASDAQ off around 0.7% this afternoon. We are seeing some weakness in the closely watched FANG name. So Amazon shares are trading lower now after hitting a record high earlier in the session. We also have Netflix off more than 3%. Alphabet and Apple are two more stocks that are in the red today in the FANG trade. Sector-wise, we are seeing 9 of the 11 sectors under pressure this afternoon. Energy, consumer staples, and healthcare are the worst performers so far. Also coming up later in the hour, we have Fed Chairman Jerome Powell. He will be giving opening remarks, and Fed Governor Lael Brainerd, she will moderate a panel of how the COVID-19 pandemic has changed perspectives on the economy. We will bring that to you live as soon as it gets underway later this hour. But first, let's kick off the show with more on today's market action. And for that, we have Christina Hooper, Chief Global Market Strategist at Invesco. And Christina, it's great to have you on the show this afternoon. Let's start with that jobless claims number. 2.4 million more Americans filing for unemployment benefits last week. How are investors looking at this number today?
Well, I don't think investors are too rattled by it. We are expecting and should expect really poor jobs numbers. That is part and parcel of what happens when you essentially shut down an economy and then slowly reopen it. Also, we of course have had extraordinary accommodation coming out of the Fed. And that has really created a phenomenon we saw in the global financial crisis, where markets have really decoupled from the economy, so that market participants, investors are far more concerned about that. And that's really what's driving markets as opposed to any kind of economic data like jobs.
Finance, how we're seeing this decoupling here between the market and what's going on in the economy. The gap, though, it's interesting because it's pretty wide. I guess my question to you is, how long do you think this can continue for?
Well, I think we can use the global financial crisis as a guide. It can continue for a long time. If we think about it, we really had stocks get way, way ahead of the economic recovery. And that really was driven by the Bernanke put. Well, now we have a Powell put that's even bigger than the Bernanke put. And it really depends now on how big and how effective fiscal stimulus is, because that will dictate how closely the economic recovery really follows the recovery in the stock market.
And Christina, how effective do you think the fiscal stimulus and the monetary stimulus has been so far? Because a lot of people are saying that this has put in a floor here for the markets, and then that also begs the question about whether or not we will need more stimulus down the road.
So monetary stimulus has been quite effective in helping the stock market. And actually, I think that in general, Jay Powell has channeled his inner Mario Draghi in terms of doing whatever it takes and assuring markets that he will continue to do whatever it takes. But we have to recognize that monetary policy is a blunt instrument. It's not a surgical tool. So it has a much greater impact on markets than it has on the economy. So when we turn to fiscal stimulus, thus far it has been certainly adequate and relatively effective, although it remains to be seen, right? We're watching it unfold, and already we know that there are some flaws in this, but it should be expected given how quickly it was rolled out. The key question, of course, is how much more fiscal stimulus are we going to get? It's clear, Jay Powell has been clear about this, that more fiscal stimulus is needed. And so we need to watch to see how much Congress is willing to give. In particular, we need some support for state and local governments. As Jay Powell noted, 13% of jobs are coming from state and local governments. So many of them have balanced budget requirements that would force very harsh budget cuts that would likely create very significant losses. So thus far, fiscal stimulus has been relatively good, but it needs to continue. It can't stop here.
And Christina, when we talk about all this uncertainty, it also begs the question about where investors should be putting their money at this point. We know that investors have been favoring growth stocks over the last several weeks. Do you think that this trade still has room to run, or is it too crowded at this point?
Well, trades can be crowded for a long time, and I suspect this has room to run. The rationale is that if we see a more muted recovery, especially in the initial stages, that suggests that the more defensive secular growth names will perform better. It's only in a scenario where we would see a V-shaped recovery in the initial stages that cyclicals would be likely to outperform. So, of course, on a day like Monday, when we got news about progress with a vaccine, there was this expectation that perhaps we would see a V-shaped recovery, and of course, cyclicals outperformed. That's probably less likely than the base case scenario that we have, which is a more halting and uneven, slow initial recovery that then gains momentum over time, at which point cyclicals would likely outperform.
All right, Christina Hooper, Invesco Chief Global Market Strategist. Thanks so much for your insight. Let's turn to the latest on coronavirus. So safety is a priority as companies around the world scramble to find a treatment or a vaccine for coronavirus. And for more on this, I want to bring in Dr. William Schaffner. He's a Vanderbilt University School of Medicine, a professor of medicine in the Division of Infectious Diseases at Vanderbilt, and a former CDC official. And Dr. Schaffner, thanks so much for taking the time. We know you're extremely busy, so we really appreciate you joining the show this afternoon. I want to start the conversation with a Reuters poll that caught our attention. And this is the fact that a quarter of Americans have little or no interest in taking a coronavirus vaccine. And some are voicing concern that the record pace in which we're trying to find a vaccine could compromise safety. My question to you is, do you think safety could be compromised? Is that a valid concern at this point?
Well, so far we've been saying, and it's nice to be with you, that in the development of vaccines, we're working very hard, we're working very fast, but we're not cutting any corners, and particularly safety. These are new vaccines and using new technologies. So all the more important to have a robust safety database before we start using it in 330 million people in this country alone. So I think the investigators are a little ahead of the hype. I mean, they're putting a little hype out, getting people interested in the vaccine. That's very good, but we need more reassurance. People are hearing we're going very fast, but what's going into their brain is they're cutting corners. And I would like to reassure people that we're not going to cut corners.
So, Dr. Schaffner, when you mentioned that, I guess, what are you looking for in these trials? What's necessary, and what do we need to tell the American people in order to give them confidence in taking a potential vaccine for coronavirus?
Well, all the vaccines, and there are many that are currently under investigation, will go into human trials. And the standard is, first we have a small group, and Moderna sent its vaccine out just recently and said we have a small trial. The first thing you look at is, in this small group of people, safety. Did they get really sore arms? Did they get fever? Did they have any more symptoms throughout their body? And the other is, you take a little bit of blood and see that it actually worked as far as we can measure it in the blood. We measure those antibodies. Then a larger group, and then finally an effectiveness trial. So it proceeds in stages, and at each time you make a decision to go on to the next stage, you have to be assured that the vaccine looks as though it's working and in the population studied has been safe. We all expect some sore arms, of course, but it shouldn't be much more than that.
And Dr. Schaffner, what is the realistic timeline? Because we're getting these recent developments. You just mentioned Moderna. We also had the news today about the U.S. giving AstraZeneca $1 billion for the development of its vaccine. So what do you think a realistic timeline is at this point?
I think a realistic timeline is sometime next year. There are some predictions that it'll be a little sooner than that, but as I always like to say, better to underpromise and overdeliver than overpromise and underdeliver. Then everybody's disappointed and they all are unhappy when the vaccine is delayed, and all those explanations then have to come out.
Dr. Schaffner, I also want to get your thoughts on potential treatments, and specifically hydroxychloroquine, because I know you have been pretty vocal about this over the last couple of weeks. So how enthusiastic do you think we should be about using hydroxychloroquine to treat coronavirus? And we know that this is something that President Trump has touted time and time again. He even said recently that he was using it as a preventative measure.
So there's treatment and prevention. And as regards treatment, there are some signals to suggest it might work and some signals that said, oh, well, not so good. We have clinical trials underway about hydroxychloroquine in treatment. I would hope that we can continue to recruit patients into those clinical trials so we can get definitive answers. There are also some trials to test whether hydroxychloroquine can prevent the development of infection from the beginning. Those trials need to proceed also. But I think patients ought to be entered into those trials. We ought to be prescribing this hydroxychloroquine for either treatment or prevention, just kind of willy-nilly at this moment, because the data are very insecure.
Dr. William Schaffner of Vanderbilt University School of Medicine, we really appreciate you taking the time. We know you're extremely busy, so thanks so much for joining us this afternoon.
My pleasure.
Well, we're going to take a quick break, but when we come back, we're going to talk about the recent data that we got for housing. U.S. home sales logging their biggest drop in nearly a decade, what this means for the reality of real estate at this point, and what we should expect going forward. We're going to have more on that when we come back. The ticker here on Yahoo Finance. I'm Shauna Smith. The fallout from the coronavirus pandemic is hitting the housing market hard. We got a new reading today. U.S. home sales logging their biggest drop in nearly 10 years in the month of April. Joining us now for more on this, we have Tim Rude, a former Fannie Mae executive, and also Citus AMC managing director. Tim, it's great to have you back on the show.
Hey, Sean. Thanks for having me.
Well, let's start with that 18% drop that we saw in existing home sales in the month of April. Is this a short-term setback, or could it potentially have longer-term implications?
It's a great question. I mean, right now, look, I think the housing market has weathered the early rounds of this crisis fairly well. 20% is clearly bad. You were coming into this market with really a record pace, though. You think about the number of home sales, new home sales, existing home sales, builder confidence, housing starts. They were all at a blistering pace from the end of February, early March. Obviously, it all came to a grinding halt in April. That really depends on what you're measuring too, to kind of gauge the overall impact of COVID. Naturally, volumes are down, but also inventories are down almost the same percentage. But if you look at things like velocity, so if you look at how quickly the inventory is turning over, it's actually turning over faster than April of 2019. And you're seeing that it's a competitive market in that you're seeing bids above asking price in more markets than you did in 2019. So all is not lost. The endurance of the market will obviously reflect, how deep and how wide the recession really is and how quickly we come out of it.
Yeah, Tim, I wanted to ask you about that because the bidding wars that are taking place is pretty interesting. And there was a recent stat I got from Redfin, and they talked about the fact that more than 41% of homes faced a bidding war between April 10th and May 10th. So when we try and just figure out what exactly that means for real estate moving forward, how big of a bump or how big of an uptick do you think we could expect for the price of homes then, at least in the short term?
Well, it's following really, you see that it's really kind of neat. You have competing forces, one, taking away from the other. So you have headwinds in the housing market, which is really driven by a lack of supply. People are not listing their properties, and rather than dropping the prices, they're just pulling the properties. So supply is shrinking, but demand is still maintaining. They're kind of colliding and pushing prices up. So I think that as long as demand stays relatively strong and supply stays consistent with that, you're going to continue to see that upward pressure. I think some of the things that are more qualitative that look interesting is that of all of the properties that closed in April, those are usually they basically 80% of them were started after or during the middle of that COVID crisis. I think they had to be right around the middle of March. We already had the World Health Organization calling a pandemic. You had deaths up in the US, you had unemployment up, yet still those people came off the sidelines and bought.
Yeah, and Tim, we could be potentially moving past, or I guess the peak behind us, at least here in the U.S. and a lot of states with coronavirus. What areas of the country do you expect to rebound the quickest?
Well, it seems like the highest priced markets are the weakest, along with the urban centers. People are trying to get away from, density, thick areas. They're getting away from what was the trend, urban centers, moving to the suburbs, moving to the exurbs. I love it because, look, we all wrote the epitaph on the suburbs long ago, and this exodus out of the cities back to the suburbs is also happening at a time where you've got what's been called the silver tsunami. You've got, seniors who are flipping over 20 million properties in the suburbs and the exurbs over the next 10 years, which is going to meet this new demand that's coming online. So if you look at areas that are seeing the hottest pace in the most competitive markets, those are like Tacoma, Washington, Seattle, Washington, Denver, but you're seeing some of the other markets like Miami, Fort Lauderdale, West Palm. Those ones are really struggling in terms of turning over that inventory and having to discount those properties.
Yeah, Jim, real quick, I just want to get your take just on where we're seeing from millennials, because you and I have talked in the past just that millennials kind of been on the sidelines. They've been a little bit hesitant to buy their first home. How do you see the coronavirus playing into that dynamic? Has it really gotten a lot of these millennials off the sidelines and looking to purchase their first home?
It does appear that way. Look, that's the hugest demographic tailwind that we've got right now is, of course, the millennials coming of age. The average age for a homeowner is, first-time home buyer is like 33. Right now, the biggest cohort of the millennials are about 31, 32. So it's lining up nicely. And as they start families later, they're going to realize, and quickly realizing during a quarantine, that raising a family in a 700 square foot apartment, isn't all it's cracked up to be. And aspirationally, millennials have demonstrated that they have the same aspirations to buy a home as their parents and their grandparents. We're seeing that definitely pick up. I think it's going to even pick up faster in the next 18, 24 months, assuming that the employment picture doesn't continue at the same pace and it's not as dire. The government's going to do everything humanly possible to maintain asset prices and to make it attractive to buy a home. As most companies or most individuals that are homeowners, 80% of their net worth is in that house. And as opposed to renters, they really don't have any net worth to speak of. So the government's going to continue to do and underwrite and subsidize housing any way it can to prop up those values. And I think that creates a good opportunity for millennials as they come of age.
All right, Tim Rood, Managing Director at Citus AMC. Always great to have you on. Thanks so much for joining us again.
Thanks, Sean.
We're going to take a quick break, but when we come back, stocks are still moving to the downside. We have the Dow, the S&P, and the NASDAQ all in the red. The NASDAQ, the biggest decliner so far today, off just around 0.6%. We're going to have more on today's market moves when we're back.
Welcome back to the ticker. We have President Trump escalating his rhetoric against China. Now, in a tweet, he wrote, quote, China is on a massive disinformation campaign because they are desperate to have sleepy Joe Biden win the presidential race so that they can continue to rip off the United States as they have done for decades until I came along. So for more on what this means exactly for the market, I want to bring in DR Barton. He's a chief technical strategist at Money Map Press. And DR, great to have you on the show this afternoon. I mean, let's talk about those comments from President Trump, the fact that we are seeing this escalating tension between the U.S. and China. What are the broader implications for the market as a result of this?
Well, I think we saw some of that this morning, Sean, and we saw with the China coming out with their potential new, much harsher policy for Hong Kong, and the markets immediately had a big sell-off. We were slightly in the green when that news came out. So this back and forth, and of course the U.S. has already responded along with other people in the world about basically removing the autonomy from Hong Kong there. So this back and forth is really, it should be a sideshow to what's going on with the pandemic. But while we're reopening America, while we're waiting to see if there's a surge, if there's no surge, if anything comes of that, I believe this
to a vaccine candidate much faster than we have in the past, putting things into phase 1 clinical trials. So I just don't want people to be I don't want to overpromise or be overly optimistic, but everything is looking good. But I think we're going to have probably a period of 18 months, 2 years or so before the population is vaccinated. We may get smaller batches before that for healthcare workers or high-risk individuals.
Interesting. So when you think about sort of the other two pieces of the medical stool here, and we've all come to learn things that you know better than anybody else around, we talked about vaccine, but also when it comes to therapeutics and when it comes to the antibody test, where are we on those other two elements?
Well, so the antibody testing is something that's been rolled out kind of in a staggered fashion, and we're starting to get more information that there are better kits out there. Some of the national lab chains like Quest and LabCorp have developed serology tests that they're using as well, and the Roche test is very good. There are some there that have a high rate of false positives, meaning you didn't really have the infection, but it's still reading positive. That we have to be careful about making sure that people don't use those types of tests and that they're using the highly validated ones. When it comes to therapeutics, I do think we're in a better position than we were just even a few months ago. There had been some positive news about remdesivir, which is an experimental antiviral which received emergency use authorization from the FDA. This does seem to get people out of the hospital quicker. It is not a panacea. It's not a knockout blow against the virus, but it is one tool that can help us preserve hospital capacity. And it does give you hope that we can make other antivirals. And there are people trying to work on antibody-based therapies, not just from recovered patients, but also synthetic antibodies. So It is looking good, and we'll probably see those types of therapeutics much before we'll see a vaccine.
Dr. Adalja, here we are at this interesting juncture, and Jason and I were planning for our weekend show. We talked a lot about this in relationship to Bloomberg Businessweek magazine's cover story about reopening. There's so much discussion about it. Do you delay? Do you go quicker? I mean, no matter what kind of reopening we do, there are going to be some individuals, right, who will be at risk, and some, unfortunately, we will lose their lives. It's just the result of increased social interaction, right? It doesn't matter when we start. Is that fair to say?
Exactly. That's exactly the truth. And I think many people don't appreciate that. The virus didn't go anywhere. So if someone says, I'm going to wait till next week to get my haircut, there's nothing different going to be. Because social distancing, the way that those stay-at-home orders were put in place was really just to an eye at hospital capacity. It wasn't going to make things risk-free, and nothing is going to be risk-free in the era of the pandemic. And people are going to have to think about what's important to them, what their personal hierarchy of values are, what they want, what's essential for them to do, what's not essential for them to do, and make these decisions on their own about what risk they're going to tolerate. Because it is true that the virus is here, and now this is something that we have to incorporate into our own risk calculation every time we step out the door.
We're talking with Dr. Amish Adalja. He is infectious disease physician at the Johns Hopkins Center for Health Security at the Bloomberg School of Public Health. As you can tell by the name, the Bloomberg School of Public Health, supported by Mike Bloomberg, the owner of this radio station, founder of Bloomberg LP and Bloomberg Philanthropies. So, Dr. Adalja, when it comes to reopening, one of the questions that we hear all the time, whether it's around our dinner tables or when we are talking to folks, is about schools, both elementary schools, secondary schools, and higher ed. We're seeing colleges say they're going to bring students back onto campus. What's your read on the plans so far?
Schools are something that's very controversial, and even the closure of them back in March was something that wasn't completely 100% supported by everybody in my field. And we do know that school closures are
Welcome back to the ticker here on Yahoo Finance. We have Fed Chair Jerome Powell and Fed Governor Lael Brainard. They will be participating in a virtual event. It's expected to get underway in less than 2 minutes. They're going to be talking about the economic effects of the coronavirus pandemic. And as we wait for that event to get underway, I want to bring in Yahoo Finance's Brian Chung. And Brian, you closely watch all of these Fed events, I guess, to say the least. And let's talk about what we're expected to hear this afternoon, because one of the big headlines and the thing that we've been talking about time and time again here in Yahoo Finance is just how the coronavirus is really affecting all aspects of the economy.
Yeah, well, as you mentioned, this is going to be a roundtable discussion, a little different than what you usually expect from these public appearances from these Fed officials, where they usually just make speeches and do a little bit of Q&A with a moderator. This is going to be a roundtable discussion, if you will. There will be a number of community advocates, people who are business leaders. There's a bank CEO, there's a restaurant owner. So a number of different parties that are all stakeholders in the U.S. economy kind of providing their views to the Federal Reserve in terms of what they're seeing amidst the COVID-19 crisis on Main Street, on Wall Street, on community group side of things. So it's going to be a way that the Federal Reserve can kind of also publicly show to those that are watching that they are taking account of not just bankers and those that are in the central banking world, but also those on Main Street that do have a stake in what the Federal Reserve is doing on interest rates and through its liquidity facilities. So as you mentioned, Fed Chair Jay Powell will be participating in that, as well as Fed Governor Lael Brainard. But this is not the only Fed speak that we've heard from today. It's actually been a very busy day in the world of Federal Reserve speak. We actually had Richard Clarida, the vice chair, speaking about an hour or so ago. He said that the net effect, I believe, will be for aggregate demand to decline relative to aggregate supply. And to translate that into normal person talk, what that means is even if the economy reopens, that doesn't mean that everyone's going to go back into the economy and start to spend again, which in many ways is kind of an argument against a quick V-shaped recovery, right? It shows that even if public policy were to say, hey, floodgates are open, go out there and participate in the global economy again, there are structural reasons why people might not be comfortable doing that. And then we also heard from New York Fed.
Brian, let me just jump in here. It looks like we have Fed Chair Jerome Powell. His comments are getting underway, so let's take that live.
Many Fed Listens events over the past 16 months, and it's important to note that these conversations are not just a nice way to talk to people from around the country, although they are that. What they provide, what you provide, is insight that we just can't get anywhere else. You add depth and definition to the flood of data that flows through the Fed every day. You give us perspective on the economic realities that don't show up on a spreadsheet. You help us see those complex sets of data that analyze the American economy through the eyes of the people, businesses, and communities that make up the American economy. And that information is very helpful to us as we make our policy decisions. So this is a valuable exercise for us and an enjoyable one as well. So we truly do appreciate it on a number of levels. The reserve banks are also continuing to hold conversations in communities across the country to help capture economic realities on the ground. We are in the midst of an economic downturn without modern precedent. It was sudden, and it is severe. It has already erased the job gains of the past decade and has inflicted acute pain across the country. And while the burden is widespread, it's not evenly spread. Those taking the brunt of this fallout are those least able to bear it. The pain of this downturn is compounded by the upending of normal life, along with great uncertainty about the future. In the best of times, predicting the path of the economy with any certainty is difficult. In fact, John Kenneth Galbraith famously said that economic forecasting exists to make astrology look respectable. We are now experiencing a whole new level of uncertainty, as questions only the virus can answer complicate the outlook. Policies that address the resumption of economic activity are the province of elected officials at all levels of government in close consultation with public health and medical professionals. But all of us have our own decisions to make as well, and those decisions will depend on public confidence that it's again safe to undertake various activities. From an economic perspective, we hope to learn a lot from your experiences and from what you're hearing from your colleagues, customers, and communities. How they're coping with that uncertainty now, how they're thinking about a future that's harder to plan for, and what matters most as they navigate the path. The feedback we get from our community and business contacts has always been crucial in how we conduct monetary policy. In extraordinary times such as these, it takes on even greater importance. So I want to thank you again for providing that insight, and I very much look forward to our conversation. And with that, I will turn it over to Governor Brainerd. Lael, over to you.
Well, thank you. So this is the 15th Fed Listens event over 16 months. We have listened to diverse voices from every type of community, every sector, and every district of our country. This rich set of perspectives is helping bring alive for us the importance of the review of our monetary policy strategy, tools, and communication practices led by Vice Chair Rich Clarida. We've heard that maximum employment brings vital benefits, takes a very long time to arrive in many neighborhoods, and is not captured in a single national statistic. We've heard that inflation matters. Households at different life stages and in different places are balancing the cost of living against their earnings, while businesses are balancing wages and other costs against their pricing power. We have heard that access to credit matters and that it's important to use a full range of tools to support the economy. When we embarked on this listening journey, little did we know that our nation would experience the heartache associated with the COVID-19 pandemic, an emergency unprecedented in modern times. Last year, we heard from small businesses that were expanding their workforces and investing in their communities. Today, many of those same businesses are running low on cash reserves and struggling to make rent and payroll, especially those in consumer services such as restaurants and retail. Last year, national unemployment had fallen to its lowest point in over 5 decades. Today, it surged to levels not seen since the Great Depression. Last year, historically challenged groups were gaining a foothold in the workforce, and employers were investing in training and loosening job eligibility requirements. Today, the fallout from COVID has cruelly hit groups with the thinnest financial cushions hardest. Workers in the lowest quartile of earnings, people of color, low and moderate income communities, and women disproportionately employed in services jobs. So as we think about how the Federal Reserve's tools and presence in communities around the country could best provide stability at this trying time and strong support for the recovery to come, we wanted to turn again to many of the same voices we heard from earlier to learn how the COVID pandemic has affected your communities and what lies ahead. So with that, I want to turn to the panelists. I'm going to ask each of you a question that references what we've heard from you in our interactions before the COVID pandemic to explore what has changed. I would invite my colleagues to jump in with their questions as we go. So we're going to start with Amanda Cage. Amanda Cage is President and CEO of the National Fund for Workforce Solutions, a role she assumed in March 2020 after 8 years at the Chicago Cook Workforce Partnership. The National Fund invests in a national network of 33 communities, taking a demand-driven, evidence-based approach to workforce development. Leveraging its local partners, the National Fund shares learning across the network. Amanda, here's a quote from you last October. What we're seeing is huge disparities in what unemployment looks like for neighborhoods. 17.2% in Englewood, 15.7% in Fuller Park, 15.1% in West Englewood. That's the best that they have ever been, and these are the same rates that we considered catastrophic for the national picture at the height of the recession. That was at a time when average unemployment across the country was below 4%. Today, it's 20% overall. How have things changed for residents of neighborhoods in Chicago, such as Englewood and Fuller Park, over the past few months? Amanda, over to you.
Thank you for inviting me to be part of this conversation today. So how have things changed for these residents? First of all, they've been hit hardest by the coronavirus. In Chicago, coronavirus cases are concentrated in Black and Latinx communities. Black residents represent 32% of the infections and half of the deaths. Latinx residents, 45% of the infections, and those numbers are rising. The jobs that sustained these neighborhoods disappeared overnight. If you worked for a hotel or a restaurant, you were a child care, home care worker, a security guard, an administrative assistant, your services were no longer needed during shelter in place. And if you were an entrepreneur and had your own small business, it shut down. And if your jobs didn't disappear, they blew up. If you were a truck driver or a warehouse worker or worked at a grocery store, you were working more now than ever and being asked to do more, to work more hours under riskier conditions. So these workers are really facing a difficult equation, risking their physical health or making ends meet. And this isn't a hypothetical question for these folks. If you live in a Black neighborhood in Chicago, you know of somebody who has died from coronavirus. You know scores of people who have been infected. And this question is weighing very heavily on families in this neighborhood. When I spoke last October, we were experiencing the longest economic expansion and the lowest unemployment rate in 50 years. And the problem that we were focused on was shared prosperity. How could we use this tight labor market to chip away at persistent racial inequities? How can we bring people back into the labor market who have been excluded? We were working with employers who were desperate to recruit and train and retain workers, and we were helping them figure out how to improve the quality of their jobs so they could be more attractive. On March 1st, I walked into a new position as the CEO of the National Fund for Workforce Solutions to work on these issues on a national scale. 2 weeks into my tenure, the world turned upside down. Now I work with communities across the country who are just trying to respond to the crisis. The National Fund has collaboratives through United Ways, the community foundations, workforce boards, and chambers of commerce, and we're trying to address the immediate needs. We're helping millions of people as they stand in a virtual line for unemployment. We're trying to figure out how to provide education and training services to people who don't have access to computers or internet connections. And we're trying to rapidly deploy laid-off workers because there are companies who are still hiring. I just want to close by talking about this 20% unemployment figure. I keep hearing the same refrain, not since the Depression era, not since the 1930s, but we have a modern day image of what 20% unemployment looks like. It looks like Englewood on the south side of Chicago. It looks like our most, our communities that are experiencing the most distress in our urban neighborhoods and our rural towns. And I think that as a country, we don't have a sense of what 20% unemployment looks like for the rest of us, even if it is short-lived.
Thank you, Amanda. I'm going to pause for just a second and see if any of my colleagues want to jump in and ask a question. Otherwise, I'll go to the next panelist and give them another opportunity afterwards. All right. Why don't we go to the next panelist and invite you to come in whenever you choose. So next, I want to turn to Pat Yakovich, who we commonly refer to as Duke, who is a former firefighter and the president of the Greater Kansas City AFL-CIO, which advocates for workers at all levels of the economic spectrum, from the players for the Super Bowl champions, the Kansas City Chiefs, to the men and women who maintain and clean the stadium. So Duke, last June, you reported that one of the really great things about the good jobs market is that it was providing the most vulnerable people in Kansas City with a foothold in the workforce. But you also talked about preparing for a downturn. Here's your quote: "If the last people you hire are the people you've determined are not your first choice, they're going to be the first ones gone. So let's make sure we've got something in place where we will offer them some ability to move to part-time or some opportunity to train for something else to stay in the workforce. But once you lose them, it's extremely difficult to get them back." Since that time, because of COVID, we've seen layoffs in some sectors skyrocket and rising concerns about health and safety in other industries. What worries you most about how workers, and particularly vulnerable workers, are doing?
Well, thank you, Governor Brainerd. I really appreciate that. So the biggest worry for me is that some of the most vulnerable will lose hope. Hope is another very important intangible that has an impact on the economy. I mean, I kind of look at it as kind of like consumer confidence, but probably a lot harder to measure. Because the people without the education or skills to be considered for a job, or the people who made a mistake and possibly had a criminal record, they were knocked out of contention for employment. Those people were getting jobs. They had the ability to make the future brighter. And we saw a movement in the right direction for women and people of color. And now far too many of them are once again out of the workforce. And we all hope it's just for a little bit longer until everybody's back and everybody makes it out and survives and is on the other side of this. But that just might not be the case. And it's really scary. You know, the stimulus checks and the increases in unemployment have worked very well to keep families solvent. But it's going to end soon. And so here's the big question we're struggling with. What's going to last longer, the money or the virus? Will we be back at work with paychecks when the unemployment payments end? And if not, how big is that gap going to be? Because a lot of people don't have the resources to be able to cover that gap for very long. So many people are living paycheck to paycheck. There's a real fear we'll see more homelessness when this is all over. Now, in 60 Minutes, Chairman Powell said that when people are out of a job for long periods of time, their skills atrophy and they lose contact with the workforce, and that longer and deeper recessions do damage people's careers. Now, it's very true. And it's also true that employees with more experience tend to have more sustainable skills and a stronger connection to the workforce that won't fade as fast as newly employed people. Most of us don't even exactly know when it happened, or some don't even realize it happened. But at some point in almost everyone's life, your job becomes a part of your identity. We use it when we describe or introduce ourselves to others. And the career damage is going to be more severe and longer lasting to those that have.
Yeah. In stocks, definitely earlier in the week. Yep, the S&P still up about 3% for the week overall. And, you know, again, I'm going to thank the Powell World Tour.
There you go. The funny thing is, you know, on those T-shirts, it always has like the different cities. On the back, it would just say Zoom.
Zoom. Oh, well done, Jason Kelly.
Thank you.
You're very
I was working on that.
Nicely done.
Just for a few minutes.
Yeah.
So it is interesting to look at also what's moving, and obviously we'll tell you more about this as the show goes on and we close the market. But, you know, retail is your two biggest retail names are your two biggest gainers, L Brands and Gap. Norwegian Cruise Lines, it's there, you know, as your number 3 gainer right now in the S&P. So interesting to see. I mean, those names have just been brutalized in many ways, retail and travel, that's for sure.
If I look at the major industry groups in the S&P 500, only one up, though, today is industrials, and just by a hair. Everything else is down. So there's definitely a negative tone in the trade today. Talk about tones. I feel like the cover story, Jason Kelly, kind of looks at some of that and the implications of what it might mean for us post-COVID-19 and the recovery.
Absolutely. So let's get into it, if we can, with the man who put it together and then the man who puts the whole magazine together every week. We're talking about the writer Peter Coy, economics editor for Bloomberg Businessweek, joining us on the phone from New Jersey, and Joel Weber. He is, of course, the editor of Bloomberg Businessweek, joining us from Brooklyn. All right, so Joel, set the stage for us, because
we want to know the conversation you guys had.
Yeah, because leading into this, and you're very kind in helping us sort of put together how we end up framing the cover story. You can listen to it every weekend. It's a great way to absorb it and to, as a companion or instead of reading it. And when you sent us the notes, both Carol and I were like, whoa, okay.
Kind of burned my fingers a little bit.
That's a take. So tee this up for us.
So Peter and I have been sort of having ongoing conversations about obviously the biggest story in the world right now, which is not only the virus, which I think he's done an amazing job covering, but the economy, which is the other thing that he covers really well. And I basically sort of asked him to say, like, okay, what's our take? What's this going to mean going forward? And the outlook is the thing that, as business leaders, I think everyone's wrestling with. Like, what's this thing going to look like going forward? And so when we started talking about that, I said, I think one of the things that we have to bring in here is a conversation about President Trump and sort of this mismanagement of the virus from the outset, and also now almost the mismanagement of perhaps reopening too soon. And if that goes, not well, that's going to have a serious impact on the economy. It's also a gamble for his reelection campaign. And when we started talking about that, Peter goes, well, there's this thing called gambling on a resurrection you should know about. And I'll use that as a way to transition to Peter. Peter, what's gambling on a resurrection?
Right, a term from game theory. So the idea would be, if you're behind in a game, it could be any game, it could be a football game or running for election or a laboratory experiment, then if you just play by conservative normal rules, you'll probably lose. Whereas if you gamble, take a big chance, there's some chance that it will pay off and you'll be very happy. And if it doesn't pay off, well, you're going to lose anyway, so no big deal. And so you'll see that a lot of executives who are losing money and are trying to keep their jobs will gamble for resurrection. And it's up to the shareholders to discipline them and make sure they don't, gamble too much in a way that ends up harming the company. So I said, well, we can carry that analysis over to the United States, the federal government. Trump is taking a fairly big risk that this reopening will work, that there will be relatively few extra deaths and that the economy will rebound, and then he can win re-election. That's good for him, but it's also good for the country if it actually works out that way. But let me just finish with the downside quickly. The downside scenario is that he loses, which he probably might have done anyway, but the country loses more than it would have under a conservative approach, because there are more deaths and the economy does not reopen quickly because you're getting resurgences and re-shutdowns and people are afraid and they're staying home.
Exactly. Like, it gets to this whole idea, by postponing, do you improve or reduce the impact by delaying the open? I feel like it's the big question that everybody's debating. The problem is, this isn't a game. You're dealing with people's lives and livelihoods. So I do wonder, kind of how you see it. What's the alternative way of kind of approaching this versus maybe what we're getting from President Trump?
Well, what we're hearing from a lot of epidemiologists is that you need to move gradually, open the things that are most critical and where the risk of new outbreaks is the smallest.
We're seeing layoffs. We're seeing people who are disconnected to these two industries that were experiencing growth before. So I don't think we're seeing the people being reemployed like we thought we would see even 3 weeks ago, 4 weeks ago.
Thank you, Amanda.
Thank you.
Well, you have been watching the panel hosted by Fed members, including Jerome Powell. You also heard from Lael Brainerd, just discussing how the coronavirus has been impacting the broader economy, really all aspects of the economy. They talked about jobs. They talked about what some of the different programs have done in order to try and help boost the economy. So for more reaction, I want to bring back in Brian Chung. We're also joined by Christina Hooper, Invesco Chief Global Market Strategist once again. And Brian, I mean, just some of the headlines that stuck out to me was Powell really at the beginning just talking about this burden and how it's been widespread but not evenly spread, and then it's been placed on those who are least able to bear it.
Yeah, that's right. So you heard from Jay Powell. He actually just jumped in the question and answer portion of this discussion, which, as you notice, has been fairly informal. It's not like those usual speeches that you hear from these Fed officials. And Chairman Powell asking a lot of these participants, hey, are people going back to work? Are jobs starting to come back? As we know, in certain those.
Brian, looks like you just jumped on mute real quick. There you go.
Sorry about that, Shauna. But as I was mentioning, Chairman Powell asking the question, are people going back to work? And I think this really signals that the Federal Reserve is interested in, I guess, the speed at which we might start to see a recovery happen, right? So we already know, based on what Fed officials have already messaged, that the second quarter, which would cover the period of April to June, is going to be very bad. But as we get closer to the end of May, if people do start to come back to work, that could be a hint that we might get to see some of that recovery in the second half of this year, as the Federal Reserve has acknowledged. But I think largely what is unique about this appearance is that the Federal Reserve is reaching out to specifically these community members who can share their side of things. You heard that very human story from the AFL-CIO representative, who said that he had to drive his family member who had cancer around, and trying to protect and make sure that his family wasn't getting COVID if they were already vulnerable, but have to go to a job that maybe requires them to be interfacing with other people, a very dangerous situation. So this is a moment where the Federal Reserve, which we tend to associate with big macroeconomic terms that most people don't understand, is trying to kind of get to the Main Street level and message and have that conversation and dialogue about how this crisis is really affecting those on Main Street. Because as Chairman Powell had said, those are really the people that are being most affected.
And Christina, I want to bring you back into the conversation here, because when we talk about Main Street, I also just want to parlay it into Wall Street and really how Wall Street's digesting some of those comments from the Fed today, and just exactly what it means just in terms of the pace and the timeline potentially of this recovery. Christina, looks like you are muted, so if you could take us.
Sorry about that. It looks like Wall Street isn't that concerned with the economic scenario because of the decoupling. But the reality is that the Fed is very concerned about it. We saw that today in the comments from Jay Powell and Lael Brainerd. And in fact, we also saw it in the FOMC minutes yesterday. There was something that I don't think got a lot of attention, but the Fed staff talked about the base case scenario in terms of an economic recovery, but also noted that their bear case scenario was just as plausible. And so I think there is a lot of concern on the part of the Fed. Of course, the Fed has a limited toolbox. And so many of the policies that it would employ to try to help the economy might benefit markets more than it actually benefits the general economy.
And Christina, just how do you take this all into account when you're trying to come up with your own forecasts and your own models? Because we heard Fed Chair Jerome Powell say in his prepared remarks that economic forecasts will be very difficult at this point, just because there is so many unknowns out there, because a lot of it just pertains to really just trying to mitigate the spread of this virus.
Absolutely. There are so many unknowns. We just don't know a lot about the virus itself. We're learning more information on a daily basis. In addition, of course, we don't know what's going to come in terms of fiscal stimulus. How much are we going to get to maintain solvency for households and businesses? So I think it's very, very difficult to predict what's going to happen. Our base case is that we see a slow and uneven recovery to start with. But certainly the path of public policy, whether it's health policy or fiscal policy or monetary policy, will certainly help dictate the different macro scenarios and how likely they are to come to fruition.
Christina, it's Brian here. I wanted to ask, what do you think is the dashboard of data that the Federal Reserve is closely dialed into? We know the story on the jobless claims. We know the story on GDP. It seems like they already have expectations, but the Fed's going to have to start modeling their own forecast in the June SCP figures. What do you think is going to be the big key on the either prices side of things or on the employment side of things to watch for?
Well, I think that anything that is more leading in nature, so initial jobless claims are going to carry a lot of weight with the Fed, but I'm sure that they're going to look at a wide variety of data. Keep in mind, when Janet Yellen was Fed chair, she looked at a mosaic of 19 different metrics just related to the labor market. And so there's just, I think, a voluminous amount of data that the Fed will be paying attention to that will paint a mosaic that helps them try to divine where the economy is. But again, there are so many unknowns, and so much of it is health related, which is completely out of the area of expertise of the Fed.
Yeah, and as we mentioned, Christina, thanks again for pointing that out. But the Federal Reserve is also really paying attention to the forward guidance aspect of things, right? That's something that the Federal Reserve is definitely going to have to watch here. Actually, in the Fed minutes yesterday, there was debate about whether or not it should be outcome-based or date-based. But regardless, a lot of things worth watching there. But one last thing at the end of the show that I did want to actually just say that this is actually Shauna Smith's last show on the 2 p.m. She's actually been participating and helping out here on Yahoo Finance, but we'll be shifting on to a new role. She's headed on to the 3 p.m. and 4 p.m. shows. So she's not leaving. We're still happy to have her, but did just want to say congratulations, Shauna, on moving to that new show. We'll see you just an hour later than we usually do.
Thank you, Brian. That was very unexpected. I know I will miss my 2 p.m. hour, but I will be joining Miles Udland for the 3 and 4 p.m. hours. So tough shoes to fill following Jen Rogers, but it will be fun. Brian Chung, thanks so much. Christine Hooper, Invesco Chief Global Market Strategist, thanks so much for sticking around. Love getting your perspective. Keep it right here on Yahoo Finance. Our live market coverage will continue right after this break.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a look at this market on this Thursday afternoon. Of course, in these times of the pandemic and the recession, we all know what Thursday means. That is the latest data on initial jobless claims. We'll get to that in just a bit. Taking a look at the market right now, the S&P 500, the NASDAQ, both off about 0.6%. The Dow is off a bit less, off 0.3%. Of 1%, and the Russell 2000, the small caps, actually higher during today's session, currently up about 0.3%. Volatility slightly elevated today. The VIX up about 1 point or so, 1.2 points here, but still trading below 30, a key level that we've been watching on the volatility index for quite some time. But again, let's take a look at those initial jobless claims numbers. Yet again, multiple millions of people filing first-time claims for unemployment insurance. 2.44 million claims filed last week, a little bit more than was estimated. We now have some 38 million claims filed over the last 7 weeks. Certainly an administrative backlog here of sorts. Unclear exactly where it leaves the labor market other than devastated, I think, for the time being. I want to bring my co-host Jen Rogers now for a little bit more on today's market and where things stand right now, Jen.
Yeah, I mean, just the labor numbers are crazy. It's every Thursday, and it is worth pointing out here. I mean, we have had our 7th straight decline, right? As we keep pointing out, it's getting better, but it's still really ugly. 9th straight week of multi-millions claim print. I have been watching on the upside. I'm going to change a little bit. I can't keep my eye off of Facebook today. And I don't know if it's because Mark Zuckerberg was out talking about how they are going to be pushing remote working. They're going to be really leading the charge for a company of their size and scale. They think they'll have 50% of workers working at home, 10 years from now. This stock, another all-time high today. And I find it fascinating when we look at the FANGs because we have other names that are off today, and Facebook just keeps plowing ahead here.
And Jen, let me chime in on Facebook because the news here is Facebook rolling out its Shops feature. And that's just one of a few things Facebook has been doing, I guess, during quarantine. You're right that it also got, I think, some positive headlines amid the race among tech companies to be the one to give the longest timeline.
On the U.S. and Europe, I mean, what do we make of this back and forth and what seems to be increased tensions, particularly coming from President Trump at this moment? Is it just it's a campaign year and it's all about that, or how do you read it, and how does President Xi take it?
Well, look, it's clearly escalatory rhetoric from Donald Trump. I mean, it's very typical of his approach to take a line and then when he gets resistance, double down on it. So last week he was saying that, I don't want to speak to Xi Jinping anymore, and that was quite a shift, because there's always been this fig leaf, as we were talking about last week on your show, where whatever else has happened in the U.S.-China relationship, Xi Jinping and Donald Trump have a great relationship, and they still get on the phone, and they can still talk through problems and disputes, and sort of it added a certain ballast to the relationship. And now he's pointing it, not explicitly today. I mean, he didn't actually say Xi Jinping, but it was pretty clear. He said that this disinformation and propaganda comes right from the top, and of course, the top in China is self-explanatory. It has to be Xi Jinping. But the thing is that this isn't just rhetoric. I mean, so you've got this angry, personalized rhetoric now, and it's being backed up by a series of actions coming from the U.S. administration, which is adding to real tension in the relationship. So, the latest was the Senate, passing this bill, which may well become law, which would result in Chinese companies being kicked off U.S. stock exchanges. Companies like Alibaba, huge companies, Baidu, JD.com. You've had the Commerce Department essentially putting in place a global licensing regime that will essentially deny Huawei access to semiconductors, or at least semiconductors that are manufactured with U.S. software and hardware, which is pretty much all the semiconductors in the world. So it's being backed, this inflammatory rhetoric is being backed by real action coming out of the U.S. side. And of course, this is on top of all the other things that we've seen. I mean, investment restrictions, technology restrictions, visa restrictions, and so on.
Well, and it's interesting, too, a headline just crossing U.S. senators to offer a bill sanctioning China over Hong Kong. That's according to Dow Jones, a place you used to work, actually, Andy Brown, back before you came into our lovely family and empire. I mean, it's interesting to see the political might on this side of the equation, the U.S. side, and meanwhile in China, and this is a story you know very well because you have tracked the career of President Xi Jinping very closely, he appears to be, by all accounts, kind of not wasting this crisis, in the immortal words of Rahm Emanuel. He's doubling down in his own way from a consolidation of power.
That's exactly right, and I think that's Jason, the point you made, about so you've got this souring of the relationship. I mean, Henry Kissinger was telling us last year that he thinks that the U.S. and China are in the foothills of the Cold War.
Right.
Okay? So now we're moving out of the foothills and we're moving into the uplands and into the mountains now. So you have all of these tensions. Then the question is, what could be the flashpoint? And we've seen just in the last few days potential flashpoints. Taiwan is a real potential flashpoint now. The Chinese are infuriated at Pompeo's, congratulatory messages to Taiwan President Tsai Ing-wen on her inauguration. Now you have the Hong Kong story bubbling. So, you've got the meeting of China, the National People's Congress, China's parliament today, which is likely, according to press reports, South China Morning Post, saying that, delegates to the Chinese parliament may well pass a national security law to be imposed on Hong Kong, which, could very well lead to a resurgence, a renewal of street protests, a crackdown, and calls for Hong Kong to lose its special trading status with the United States. So, and again, this is just two flashpoints. You've got the South China Sea, you have the East China Sea, you have many other places where the U.S. and China potentially could come into really serious conflict.
Right, multiple flashpoints. But to speak to, Andy, what Jason said, President Xi, meantime, there's another story on the Bloomberg about how China's got a new $1.4 trillion plan to overtake U.S. in technology. Meanwhile, they make these long-term grand plans, to move their economy into the future. And, they're moving ahead. And I do wonder what we're missing, as we focus on this spat, once again, coming out of the White House.
Yeah, look, Carol, exactly. So, when what to the United States is decoupling, to China is self-reliance, right? So the message they're taking away is we cannot trust the United States. Mm-hmm. We have to develop our own technology. So this is doubling. This is China. This is Xi Jinping doubling down on technological self-reliance, saying, look, we're in a long-term war. I mean, they've accepted for a while now that this is confrontation, and they're in a long-term struggle with the United States. So $1.4 trillion. They've been moving in this direction for quite some time. This COVID-19.
That is something to keep an eye on. Similarly, at the state level here in the U.S., we are seeing, some states that are seeing slight increases in hospitalization, including some of those states that we were concerned about with opening up too early, like Georgia. So definitely something to keep an eye on. Meanwhile, earlier today, we heard about AstraZeneca, one of the largest pharma companies, agreeing to distribute a vaccine from Oxford University if and when they do make it to market. They've already agreed on that for the UK, but this agreement for the US comes along with $1 billion from the Health and Human Services Department, one of their arms, BARDA, that's been given money by Congress to distribute. Really significant move there, because $1 billion is a lot larger than what other companies have received, including some US-based companies. So not sure if that really speaks volumes of, what the confidence level is in Oxford's vaccine. We know that Oxford is one of those ones that's further along, Moderna, Oxford, as well as the Chinese company CanSino is the other one. So waiting to hear, more about the details of that. We do know that AstraZeneca's strategy is to only go forward producing at risk these vaccines, which is a strategy that other companies have employed because of that government funding. So without that, this wouldn't be possible. And so that really expands the potential for the U.S. To receive vaccines. Meanwhile, speaking of vaccines, there's a new poll out that some people are probably not going to want them. The rush for increased timelines, and just looking at how that's going to affect safety or potential safety issues. There are concerns there about that, about whether, and that I think speaks to also the confidence that they have in the administration and the FDA. But it could just be people's sentiment, and the FDA does have its credibility to worry about and on the line. So we will definitely be seeing just how quickly we do see a vaccine get to market. Miles.
All right, Anjali Kemlani with the latest on the coronavirus outbreak. All right, coming up on the other side of this break, we're going to talk about a surprising bullish call coming out of Credit Suisse, the firm getting bullish on the cruise industry. We'll discuss in our call of the day coming up in just 2 minutes.
It's like a little Mensa Society meeting.
All right, welcome back to the final round here on Yahoo Finance. Miles Zeldin with you in New York. It is time now for our call of the day. Today, we're taking a look at Credit Suisse's latest note initiating coverage of a couple of cruise line stocks here. And surprisingly, the firm bullish on 2 of the 3 names, initiating coverage of Royal Caribbean with an outperform rating and a $67 price target. Norwegian Cruise Lines, that stock outperform rated $21 price target. The firm a little bit more cautious on Carnival. They've got a neutral rating and a $12 price target on that stock. All 3 names are higher during today's session. Royal and Norwegian up in excess of 8 percentage points right now. Now, of course, these stocks are still off more than 65% so far this year. But Jen Rogers, Credit Suisse here is basically saying that the cruise industry, one is these companies are not going to run out of money within the next 9 months, which in this environment counts as good. The stocks are at record lows. And, cruise vacations have a place in the American budget that probably isn't going to change. It's a cheaper way to get a lot of what consumers can get going down to the Caribbean. And, I think in this time, in a recession, cost-conscious options are going to be in favor.
I love this note because it really gets you to think about cruising differently. And if you don't change your mind every now and then on something, then you're not living. And this note got me to really take cruises at a different approach, because they are all about repeat business. We might not have, you just asked in the break, who'd been on a cruise? I haven't been on a cruise. You haven't been on a cruise. Dan hasn't been on a cruise. Andy hasn't been on a cruise. But guess what? People that go on cruises, they're repeat customers. It's 82% of the same people going back. And you think they're old? They're not old. The average age they point out in here is 42. So they're young. They have more years left in them. They might be willing to take some risks. And guess what? People aren't flying anywhere. They point out this is a movable asset. You can take it, you can put it a different place where the hot spot is, and often you can drive to it. So we've been just trashing cruising through this whole pandemic. I thought this was a pretty convincing note to take a look here.
I'm happy to take the other view. in terms of whether the note is convincing. A couple of things I'll note. The reason we've been trashing cruises through the pandemic, not just because of their outlook, but we remember Carnival's missteps. And actually, I'm happy to mention there was that great Business Week cover, I think maybe 4 weeks ago with, what was Carnival thinking is the cover language. So that was a misstep that, all these companies are facing problems during this pandemic, but they didn't need to continue operating as many days or even weeks.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks lower across the board. The Dow, the S&P, and NASDAQ all declining. Let's head right over to the first word break.
Right, though. And then also, this is why we watch Yahoo Finance, because from right now to at some point, they are going to be great stocks. And if you hit it right, you're going to make $1 million. But I don't know if that time is now.
Well, and Andy, they have a chart in the note that I think basically kind of gets at your point, and that they're looking at pricing, basically by like when the boat would leave. So, pricing is basically back to the levels that it was pre-pandemic for trips that are at the beginning of 2021 and into the second half of 2021. And so that's basically saying if you look out 18 months from now and 9 months from now, even people want to get onto a cruise ship because that's something that they like to do, but that's replacing the demand that existed. So when a stock goes down 65% and the industry is suggesting it'll get back to level set, well, we can do the math on how much growth there is from there. But what's the terminal value of it? How much more growing is there to be done in the cruise space? I think that's a lot more of an open question, but certainly a big part of this call is these stocks were at record lows. People thought these companies were going out of business. They're not going out of business, and a lot of their customers are very excited to come back and spend money with them.
Yeah, no doubt. And you can get not only can get a cheap stock, you can get a cheap cruise. There's going to be people and I'd love to have them on the show. 2 years from now, it's like I bought, this 20-day cruise for $300, and I bought the stock the same day, and I made $1 million on the stock, and I spent $25 a day going around the Caribbean.
And I had a great time.
I want you to come back 2 years from now, and it will happen. It will happen.
I got a comedy show. I got a slide, a climbing wall.
Big time, right?
You guys, here's one other fact for you. They said 55% of people that could have gotten their money back took a credit. I would have thought 100% of people just asked for the money back. 55%. And remember the hotel booking guy we had on, who, when we said, where are all these people coming from? They were coming from the heartland. They were traveling to the coast. I think people are going to go back to cruising after I read this note. That's all I'm going to say.
How about you, Jen? You going?
But I never went.
Yeah, but to Dan Roberts' point, we need the new, right?
Well, yes, that will be, but I'm not a cruising family. The new will be the generation of people that come up from these people.
Your kids are cruisers?
Yeah, there's cruising. Cruising is like a thing families do.
That's like the argument the golf industry makes. Well, everyone will age into golf.
Well,
all you need is enough people to age into golf and cruising, and you can make the numbers work. All right, coming up on the other side of this break, we are going to be joined by our old friend Brian Sozzi, talking a bit about his interview with Coke CEO James Quincy on that business, how they've held up during the COVID pandemic. Also going to go through a bunch of retail news right in Soz's wheelhouse. That's coming up in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Othen with you in New York. We're joined now by Brian Sozzi. He is the co-host of The First Trade, longtime friend of this program. But Soz, it has been quite a while since we've seen you during these hours. Great to see you. You recently sat down with Coke CEO James Quincy to talk through how their business is handling this time. Tell us a bit about that conversation.
Yeah, Miles, thanks so much for having me back on. Big fan of the show. Watch daily on YouTube, as always. But yeah, talked to Coca-Cola CEO James Quincy, Chairman and CEO James Quincy. Asked him how his business is doing after I think he dropped a bomb on a lot of people in April by saying global volume was down 25%. Here's what he said.
We're seeing in two thoughts. One, we're seeing an improvement and really the predominant feature of the business in the very short term is going to be the degree of lockdown. The degree of lockdown, given that half our business is at home for at-home consumption and half our business is away from home consumption, the degree of lockdown is really what's driving the impact on the away from home. And as those lockdowns around the world are starting to ease in different ways and shapes and forms, there is a slight uptick in the business. But and that's a reason for cautious optimism. However, we have to be cautious because there is and there have been cases where it goes backwards. Just because it reopens doesn't mean it won't reclose. We can see in Japan, we can see in Singapore, we saw in temporarily in increase the risk of flare-ups and then the restrictions come back into place. So we see these reopenings, the reduction in lockdowns and reopenings as positive from an economic point of view. But we are also cautious that we are not necessarily witnessing the end, but yet the next stage of how this is going to play out.
So, Miles, one thing I haven't talked about throughout the day on all these clips is that I think you're going to start to see more affordable soda, more affordable seltzer in the marketplace. I asked Quincy what will be one of the byproducts of the current environment. He said affordability. Affordability is going to be a big key. So you'll probably see smaller pack sizes, maybe some cheaper soda. I'm all for it. I really dig Coke Zero.
I find it interesting, Sazi, that a company like Coke would actually change kind of their pricing strategy at a time like this because it's a consumer staple, right? This is something that people who are buying Coca-Cola products, whether it's a soda or whether it's Dasani water, any of these, they're usually going back to those on a fairly regular basis. And I guess, they got the restaurant channel, but I'm surprised that their business seems to be under this much pressure considering their presence inside the grocery store. We've all been going there a whole lot more. It's kind of an interesting business, I think, to face challenges of this magnitude in this environment.
Yeah, the thing with Coke, unlike Pepsi, Coke has close to 50% of their sales tied to what analysts say away from home occasions. So sporting events, you go to the convenience store, you pick up a Coke. Also restaurants too as well. That business has been hit very hard. When you have 50% of your business not operating like it should, you have to do something. And I think what you're seeing with Coke, what you will see with some of the lower prices, is that a lot of consumers have ingrained new habits. Do I need to have that Coke in the morning? I probably not. Maybe not. I've been drinking water, so maybe I won't need a Coke. But if it was 50 cents, I'm down for it.
Yeah, all right, Saz, let's switch gears a little bit while we have you. Talk a bit about the retail space. Some grisly news there all week. Let's start with what's going on at Macy's in their news earlier today.
Yeah, Miles, this morning Macy's came out with their preliminary results. I was on the webcast call with Macy's CEO Jeff Jeanette, which was being held at JP Morgan, virtually, of course. It was depressing. It was a depressing call. There's no other way to put it. Even the stores that have opened are not seeing a lot of traffic by Memorial Day weekend. Macy's will have 270 stores open. And I have to wonder if they will be complete ghost towns. The only thing you might see is people coming up there, picking up their shirts from the curb. Curbside delivery is one of the biggest trends in retail right now, and it is playing out at Macy's, but it's depressing. One thing they did tee up, and I'm surprised the stock hasn't completely fallen off the map on this, another big financing raise. I think over the next couple of weeks, you'll see Macy's raise a large amount of money at a very penalizing price.
Yeah, Brian, I just have to tell you that I was on a call, JP Morgan call with Doug McMillan, and listening to him over at Walmart with Greg Penner, the family chairman. And what shocked me in a way, sure, they were talking about how things were difficult and all that, but this is a company that is just clicking, right? I mean, there was no talk of weakness, never mind bankruptcy. And I think that this is a theme that we are hitting on, which is the difference between the haves and the have-nots. And you and I have talked about this a lot. I mean, nowhere is this reality more stark than retail. I mean, there are companies that are fine, doing well, and then there's a whole lot of companies feeling pain. And then you have to wonder, what is the prognosis for Macy's?
No, you're right on, Eddie. What we've learned the past 2 weeks of these retail earnings is it's Walmart, Target, Home Depot, Lowe's, and of course, Amazon. These are the companies that are absolutely kicking the face in of a JCPenney and a Macy's. Most of those stores, for the most part, those chains remain closed. And if you have the money, you have the balance sheet of a Walmart, you can go out there and continue to invest in your business. You can hire the best names in retail and go out there and reskill your workforce and take more market share.
Sazi, if we shift away from just Macy's and look at some of the other names that during this time we've heard about, and of course, a common theme is for some of these names, like JCPenney, well, it wasn't like coronavirus is what did them in. These were weak names before coronavirus, and maybe it was a gun to the head of an already wounded person. But my goodness, JCPenney, then today Victoria's Secret closing something like 30% of stores. And then, of course, we have the J. Crew filing, and J. Crew includes Madewell. My question for a lot of these would be, which ones can survive by slimming down? And, many of them overbuilt, so maybe for some of them you close stores and you emerge from this time, and which ones this is just a yield sign on the road to going out of business. Because, of course, the average layperson sees headlines like the one about J. Crew, and they say, oh, man, I see this a lot. They say, wow, J. Crew out of business? It's like, no, it's not out of business. It's filing for bankruptcy, but maybe eventually.
No, Dan, these are just zombie retailers. We've learned consistently over the past 25 years in retail, you can't close stores and run a sustainable long-term business. Sure, you pump up profits, maybe your stock price in the near term, if you're still even publicly traded, which is not the case with J. Crew, and it won't be for JCPenney near term. But that's not the way to do it. You fade out of the minds of human beings, and you push those shoppers online. And where are you going online? You're going to Amazon, Target, Walmart, Home Depot, or Lowe's.
Lululemon shares hitting a record high today, up 3.5%. Another one I think that's just scooping up a lot of these trends that have moved away from these mall retailers.
Miles, that one basically has doubled since that March bottom.
Their clothes fit great. Love
Are you? Is that a Lulu sweatshirt?
I'm wearing some now.
This is Theory. It's high end. It's slim fit, but that's what Lululemon does. You know.
Theory, what are we paying this guy? We gotta let's talk about this. Let's talk about this offline. All right, Brian Sozzi, great to hear from you. Always good to see you. We'll catch you on the first trade 9:00 tomorrow morning. Coming up on the other side of this break, we're going to talk to Jared Blickery, take a look at this market. Also, reports that Uber and Grubhub are closer to a deal. We have the latest coming up with that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Ludden with you in New York. Let's take a look at this market right now. All three majors currently lower on today's session. The NASDAQ down about 0.8%, leading the way lower for the majors. Let's go to Jared Blickery now for a quick look at where things stand with about 25 minutes to go in today's session. Jared.
Yeah, we have the Dow off less than 100 points. Pretty low volume, choppy day. You mentioned the NASDAQ. Just looking at the NASDAQ heat map here, lots of red, tech under pressure, the second worst performing sector next to energy. To the upside, we have consumer discretionary doing very well along with industrials. Those two sectors are the only ones in the green. Consumer discretionary really relating to a lot of those earnings in the retail sector that we were just talking about with Brian Sozzi. Facebook, a standout here, another record high. You can just see year to date, up nicely, 13%, and it's been making record highs for, I believe, the last 3 days. We can also take a look at the sectors, and as I said, industrials in the lead here. We did have discretionary. I'm not sure where that is, but I'm pretty sure that's in the green as well. And then kind of in the middle of the pack, just looking at healthcare, materials, utilities, kind of some of the more boring sectors or defensive sectors, excuse me there. Those are just in the middle of the pack. And I want to take a look at the S&P 500 futures, and this is going to allow us to see kind of that choppiness that we've been seeing. If we take a 5-day look, we can see we're maintaining this range up here, just kind of waiting to see what the next move is going to be. But over the last 21 days, we're also in a range of a much greater magnitude, although we have broken up, as we noted yesterday. Just can't really punch through right now. And if you draw a trend line from the March 23rd lows, it's going to come up something like this. Pretty interesting. We have this wedge forming. So if we were to break down to say below this point, which is 2906, probably get some downside follow through. We break to the upside, probably shoot to 3000, where we have the 200-day moving average and even above. We had somebody on the first trade saying on a technical basis, the S&P 500 could break all the way up to 3200. and really not mean much in the long term. Miles?
All right, Jared Booker with a breakdown of where things stand in this market. Let's move now to some reporting we got earlier this morning from CNBC's David Faber about Uber and Grubhub moving closer to a potential deal. Reporting from a number of outlets has sort of indicated that price is the issue here, likely to be a stock transaction. How many shares of Uber Grubhub shareholders receive seems to be at issue. But Andy Serwer, I think, whether this deal goes through, I think that the antitrust question for me remains quite open in this case. And I don't think it takes an antitrust lawyer to think that. It just isn't clear where this administration and the FTC would really stand on this.
Oh, dude, I'm ready to represent Uber on that one against you in a court of law. I mean, come on, there are a lot of other players in this space, and there's one in the city of Seattle I can always just point to, right? I mean, I don't think it's going to be a problem. I mean, particularly because, you look at a company like Grubhub. I mean, it's not exactly, a threat to the marketplace in terms of its market share or its power over the consumer right now. Now, restaurants might argue with me on that, but there's still, I think, plenty of competition in this space. I think it will get through. I don't know why this is really playing out in the public sphere so much and why these people can't get the deal done. You got to shut your people up, shut the lawyers up, and execute the transaction. That's be my take on this thing.
I tend to think, too, that this deal will go through just fine. Now, I wonder, Andy, if regions will come into play and regional market share, because you're right, the food delivery space is so crowded, but it's also so regional. And it's the same as with, peer-to-peer payments. Like in my world, everyone has Venmo. And what are you doing if you don't have Venmo? But in certain parts of the country, everyone uses Square Cash instead of Venmo. And similarly, Grubhub, or I should say Seamless, which is Grubhub in New York, is still top dog, as I understand it, by far. Uber Eats has been growing, but not nearly as big. Uber Eats is more dominant over on the West Coast in places like SF. And I wonder if that helps as an argument, the idea that even once we combine, it's not unfair and there's so many other players. I also think that the deal makes a lot of sense for Uber. I think that Jen Miles and I have come to that conclusion along with Melody Hahn. We've been discussing the reports about this deal many days in a row. It makes sense for Uber. That said, there are some crazy optics right now. I mean, the company just went through a second round of layoffs in the last 2 weeks. So if you are an employee of Uber, or if you're an employee of Grubhub, you wonder, it's like, well, is the inevitable next step once the companies combine big cuts, even though I'm sure for now Uber would say otherwise. But just interesting optics, the fact that Uber would be even able to financially make a deal like this when they're slashing so many jobs too.
The deal's going to get done because the deal has to get done because the economics of this business suck. So they're going to figure out one way or another. And if it's not these two pairing up, somebody else is going to pair up. But it just doesn't make sense. There's too many of them. They're not making money.
What's the combined name, you guys? Gruber, or change the whole thing to Uber Eats?
I think it's sadly Uber Eats, but I think Gruber's kind of interesting.
Seamless by Uber Eats. All right, let's switch gears here and talk a little bit about a kind of a growing story, a groundswell, I think, of support for college campuses actually opening. By the time August rolls around, the local concern here is NYU announcing within the last 48 hours its plans for getting students back on campus, the way they're going to kind of break up the academic calendar in a new way. And, Andy Serwer, we've talked, it's been interesting. Go back in time for 4 weeks, and none of us could have possibly imagined any students on a college campus ever. And here it is, and it seems like basically California state schools that called their shot 2 weeks ago, they might be the odd man out. It seems like most colleges are going to try to give in-person classes a go on some level.
There are so many things at play here, and I'm on the inside on this a little bit. But number one, things change and they're evolving all the time. And you're right, maybe California went too soon. Number two, schools have different financial situations. And some schools that are in a tougher financial place may feel more pressure to open. Number three, they have different constituents in terms of blue states, red states, in terms of wealthy people, not wealthy people, in terms of being a community college. And then you've got so many models. Another model besides this one, starting early and get the people out before the flu comes back, there's one where you allow the freshmen and the seniors to go onto campus, and the sophomores and the juniors have to study from home, because it's more important for the freshmen and more important for the seniors. And the juniors and the sophomores, who cares? You guys can sit it out. So there's so many things, and it is burning up the Zoom lines with these boards of trustees, trust me, figuring this out.
Guys, I also wonder, as Andy said, there's so many things to unpack here. And you also have to wonder that even if a lot of these schools can make it work to say, come back in August, some schools coming out saying come back as early as August 10, I heard for some schools, and then the semester will end before Thanksgiving. We'll compress the whole schedule and you'll take your finals for the semester before Thanksgiving. Fine, but even if you can do that, then you have to get into is it even worth the experience for the students? Now, I know some would say, oh, absolutely. Better to be there for a much shorter time than to be stuck at home. But you have to start considering questions like if certain schools are going to do online classes anyway, certain name brand schools, or if they say, okay, you can come back, but it's for a much shorter semester. Well, you're paying through the nose for a fancy pedigree degree from one of these schools. Is it even worth it anymore if the new normal is much, much, much condensed semesters or even online courses? Why not go to University of Phoenix?
And then you just raised a really interesting point, which is flexibility in terms of tuition, Dan, right? So in other words, you're just assuming full freight, but the colleges and universities could change tuition. And then to what degree? In other words, if $100 is the full experience, to what degree are you not offering that full experience, and how would that be reflected in the less amount that you charge?
Well, if I were a parent, I'd want to pay less if my kid is going to be there for such a short time.
I know you would.
I mean, of course, USC, to name one, already came out and said, oh, we're still raising our tuition, even though it'll be totally different.
One other thing, and this goes into kind of what we've been hearing from all these companies reporting earnings, that even the ones that have done well, it's costing more to operate in this environment. And that's something that the schools are all going to face as well. So when you talk about the revenue picture, the margins or something, they're talking about getting everybody a single. How do you do that? You can't go to the cafeteria. Everything has to be boxed up now for your food. The costs are increasing and what's going to be coming in is decreasing. It is a very tough time. Even if they can open, this is a multi-year issue for a lot of these colleges.
Yeah, and then Furman University canceled its D1 lacrosse program, Jen. So you're really getting down to some serious.
No, the sports are, I feel bad for them, but the sports are hard because that's what if you only have freshmen and seniors come back? I get it, but there's going to be no teams, and everything that you want out of your experience, you're really not getting.
Well, experience in the staying alive, and not necessarily for the kids, but for the faculty and the staff and the parents it's complicated.
And for the economy of a town like a Madison, Wisconsin, a Bloomington, Indiana, Ann Arbor, so on and so forth. Again, many, many issues here. Certainly will be a question through the summer. And I guess if these schools open, we'll sort of see what happens when cases inevitably pop up on a number of these campuses. All right, coming up on the other side of this break, we're going to talk to Michael Gappin of Barclays about where the economy stands, talk about the labor market, this morning's initial jobless claims, and we have to ask him which letter he likes at this point in the proceedings. We're coming up with that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles London with you in New York. We're joined now by Michael Gappin. He is the chief U.S. economist over at Barclays. So, Michael, let's just start with where we stand. I think in the troughing process, or trying to get through this initial shock. I think a lot of folks have said, well, the absolute worst of the economic data might be behind us. The data coming up isn't going to be good. I guess, where do you see things standing as we head into the summer months?
Yeah, I think that accurately describes it. The April data, of course, was awful because of the statewide stay-at-home orders. So all of the April data, very unprecedented, very weak. The May data on an absolute level, of course, is still extremely poor, but it seems better than the April data. We saw that from the PMIs this morning. Both services and manufacturing still very much in contractionary territory, but better than we saw in April. Initial jobless claims, the good news there is they're coming down. Of course, they're about a third of where they were in the early to mid-March or even late March period. But obviously, they're still at unprecedented levels. So the trajectory seems to be that April would be the trough in terms of the sharpest contraction in activity, some better performance in May as states begin to reopen, and we would expect June to show that further improvement. So if you look at the months within the quarter, April would be the weakest, although the quarter as a whole is still going to be, as bad as we've ever seen in terms of GDP growth.
So I want to ask a little bit more about the labor market, because we've had 38 million claims filed in the last 7 weeks, and a number of people pointed out that there was that temporary layoff number in the jobs report a couple of weeks ago suggested maybe there would be kind of mass rehiring of folks. As you look at the labor market right now, we have an unemployment rate that's likely going to head north of or to around 20% in a couple of weeks. Where do you think that there is the potential for a big wave of rehiring as we head into the summer, or have we maybe overestimated perhaps the stickiness of some of these furloughs and temporary layoffs and things like that?
Well, I'd just remind people that temporary number came from sampling households, right? What do you think? You think this is a temporary layoff, or do you expect to be laid off for longer? And I think the answer from the worker side of the view is, I kind of expect this to be temporary. And I think you're right that there's probably a fraction of this employment that will come back, or this unemployment that will come back relatively quickly. And by that, I mean over the 3 to 5 month kind of horizon. But we still expect the unemployment rate to be around 10.5% in Q4, so still double digits. So we might reemploy half of those who were unemployed by the end of the year. And we think it'll be a tougher slog for the remaining, because we don't believe all these service sector jobs are coming back, and we're going to have to operate with less. So as I'm sure has been well discussed on your show, restaurants won't be back to full capacity, neither will travel, leisure and hospitality. So yes, there will be, I think, a significant amount of reemployment, but it's going to be a long slog to get back to full employment.
Hey, Michael, when it comes to calling this a recession, we rely on either the 2 quarters in a row or the NBER. But what about Michael? Does Michael just say this is a recession? Do you tell your bosses? Your bosses ask you can we officially characterize this as a recession, or even maybe something worse?
Yeah, absolutely. I think we started calling that in March when we saw the surge in unemployment claims, because then it was clear to us that we would get negative growth in the first quarter and likely a substantial contraction in the second. So based on the labor market and the amount of firing, I think it's very difficult to characterize it as anything else other than a recession. So what you want to call it, the COVID recession or the COVID pandemic, I think we're definitely in that, and we've been using that type of terminology since March.
So, Michael, we had on Yahoo Finance today the CEO of Coke, and Brian Sozzi, one of our anchors, was on breaking it down for us just a little bit ago, and he talked about how we might be seeing Coke prices be cheaper in the future. And it got me thinking about deflation again. And I want to know if you think that that's a risk. Like, look, if Coke is going to be cheaper here, is that a sign that we could be seeing deflationary pressures for other companies? And is that a concern?
Yes, we actually think risks are still to the downside. We think core inflation will fall to about 0.5 year on year in Q1 of next year. We think all of this is really based around a drop in demand, a still strong dollar, a lot of discounting that's likely to go on. So we have a lot of disinflation in front of us. And I'd like to add one additional thing that we're keeping track of very closely. Normally, we would say the U.S. exhibits nominal wage rigidity. We're very reluctant to cut wages in downturns. But this time around, we're reading a lot of stories, seeing a lot of corporate earnings reports that suggest there are outright cuts in wages and salaries, which could mean even more downward pressure on inflation in the near term, meaning over the next 3 to 4 quarters. So it's not unrealistic to think that core inflation could dip into deflation temporarily. To get a debt deflationary spiral, you'd need a resetting of inflation expectations, maybe a W-shaped scenario. But we clearly believe that this is disinflationary, and we wouldn't be surprised if some nominal wage flexibility gives you outright deflation for a couple months, if not a couple quarters. I think that's very much within the realm of possibility.
And then, Michael, last before we let you go, I don't know if you guys are thinking about this in terms of any of these letters, but I'm sure that you have many clients asking you, is this a V, a U, a W, so on. How are you responding, I guess, to that line of inquiry?
So I'm calling it a reverse J. And,
Seriously?
I'm trying to come up with something new. The idea being you are likely to see a pop in activity in the third quarter, a change in growth rates, a strong growth rate in the third quarter, but we don't make it all the way back. So you drop down, it comes back, and then you get the slow gradual recovery. So a reverse J is what I call it.
I like it. We're all drawing it right now.
I'm drawing it.
Yeah, right.
I was just going to say, that is the first time we've heard that on our air. That's the first time I've seen that really kind of mentioned anywhere. So innovation in the letter space. Michael Gappin with Barclays. Always great to get your thoughts. Thanks so much, and we'll talk to you soon.
Thank you.
All right, coming up on the other side of this break, we'll take a look at the market as we head towards today's closing bell. Just over 6 minutes to go in today's trading session. We're back here in just 2.
Thank you for that.
All right, welcome back to the final round here on Yahoo Finance. 4 minutes to go in today's trading session. Market's moving lower here. The NASDAQ is now off nearly 1 full percentage point. The S&P 500 off about 0.8%. I want to very quickly look at a sector we haven't talked about today, and that is the banking sector. KBW Bank Index right now off about 0.8%. We've seen a really nice rally in the banks a couple of days this week, but giving back some of those gains. And you kind of look at a bunch of these names, look at your Cities, your JPs, Wells, all these names are off 35 or more % from their highs. And so the banks still remain under quite a bit of pressure. And this coming with Facebook shares making, pushing towards new highs today. But overall, some of these trades that have worked not only this week, but overall during this period, cooling off a bit today. Amazon and Netflix shares, they're down about 2%. All right, coming up in just 2 minutes, we're going to have the closing bell for you on this Thursday afternoon as we square up the second to last trading session ahead of a holiday weekend here in the U.S. And we're back with that right after this. All right, welcome back to the final round here on Yahoo Finance. About 40 seconds to go in today's trading session. Markets sliding a bit as we head towards today's bell. The NASDAQ right now off about 0.9%. All three majors lower on today's session, though we still have the small caps, the Russell 2000, up about 0.3%. Again, as we head towards the bell here on this Thursday, we're going to have a long weekend here in the U.S. We'll see if there's any volatility during tomorrow's session as things square up ahead of a 3-day trading break. All right, those are live pictures from the floor of the New York Stock Exchange. Again, we are now just one full trading day away from there being a few more people down there on the floor. Certainly not a full staff on the floor come Tuesday, but we will see a number of folks return to the floor of the New York Stock Exchange, the company announcing that last week. A sign, maybe a small sign, perhaps, things normalizing a bit. At least here in New York City, I think it'll make us feel a little bit better, like things are making some kind of progress as we move towards a phase reopening, whatever you want to call it, phase 1, 2, 3, everyone trying to figure out what the summer and beyond may look like for them. Again, let's take a quick look at this market right now because the NASDAQ, again, finished down 0.97%, 97 basis point loss there on the NASDAQ. The S&P 500 just under 2950. Of course, you'll remember during yesterday's program, we talked with Jared Blickery about whether today would be the day the S&P would get back to 3,000. Guess we could give it another go tomorrow. We'll see if we have a couple percentage point rally in us. But the market right now, and Jared broke it down in the last half hour, some folks think the S&P moving to 3,200 wouldn't necessarily change the longer term picture. Obviously, we have a lot of concerns with the virus and the economy, the labor market, and so on, corporate profits to work through here. So the market, though it has made a huge rally off of those lows, very, very uncertain future ahead of everything we're looking at here in the U.S. I want to bring in my co-host, Jen Rogers, now for a bit more on today's market action. Jen.
Hey there, Miles. So I think you're right, just talking about this return to normalcy, just pointing that out there when we saw the bell, right, that we're going to have some more people down there again. As we reported yesterday, all 50 states have some level of reopening. I think another story that has reminded me and people on the street and people that work in finance that business is going about is the possible merger, this talk going on between Uber and Grub, that's going on as well. And, I think that another part of what's making it seem like we're getting back to business is this virtual IPO that we had today. So you are on the floor. We wait host and people stand around there. Today, we had a virtual one, and Inez Ferre is joining us, who's usually down there on the floor. We haven't seen you in a while, Inez. How are you?
Good to be with you, Jen.
So good to see you. So you got a little reporting done on how this virtual IPO actually went off. How did they do it?
So I just got off the phone with Peter Giaccio, and he's a senior DMM, designated market maker with Citadel Securities. And they actually have been selected to do most of these remote IPOs. Actually, there's been some other IPOs that have happened remotely, but a lot of them being SPAC, special purpose acquisition companies. But there's been two operating companies, and one of them was today SelectQuote, which had priced their IPO at $20 a share. They opened at $26.20 a share. And I asked Peter just basically about how this works, because I have seen him opening many of these IPOs, executing many of these IPOs from the floor of the exchange. And he has done this remotely now. And he was telling me that with the first one that they did, they actually had an individual DMM at his home ready to execute the opening, another DMM as a backup to that DMM remotely at his home. And then Peter, who had gone down to the floor as a backup to the backup. This one was done all remotely. He told me that the DMM is VPN to NYSE's system. Basically, the data, he said, is feeding in real time with volume and price, and it's all being done electronically. The brokers have information. They've got all that data there. When they're normally on the floor, they can see it on their screen. Well, now they can see it remotely, real time as well. I asked him also, as far as the timing is concerned, if this impacts the time of an opening. He said, no, it's roughly been the same time. He really said that this has all gone on very, very seamlessly. So as far as going back to the floor, on Tuesday, we know that there's going to be the first wave of brokers who will be going back to the floor, but the DMMs won't be going back just yet. So you can expect to see other IPOs happen virtually in this sort of new world that we are living in right now. And as far as the floor is concerned, as it gradually starts reopening.
All right, and as for with the details on that virtual IPO, I guess the IPO window is opening a little. It's like when it's like a window's jammed. They're getting it up just a little bit, and eventually all the way open, and maybe Inez will be back down there for us. Great to see you, Inez.
Great to see you too, Jen.
So back to some of the news of the day here, of course, the weekly jobless claims numbers coming in. Rick Newman, we've been talking about the reopening here. Look what's happening at the floor of the New York Stock Exchange, the new normal or the new abnormal, whatever you want to call it. But for 38 million Americans that have filed for claims, things are very far from normal. So the economic picture, I don't know, how do you want to describe it? Pretty ugly signs?
Of course, but there's so much bad economic news that I don't think markets care about bad economic news anymore, because everything is literally off the charts. Everything is the worst since the 1930s. So for about a month, my guess is no economic news is going to be bad enough to move markets to the downside. You know what I'm looking for in terms of what might move markets down is some slippage in the states that are reopening, and just about every state now has reopened a little bit, at least. I think what would spook markets would be if we saw resurgence of virus in some of those areas or any outbreaks that you could attribute to reopening. And certainly if any state had to reverse itself and begin to close things again, that's kind of the worst case scenario for the economy overall, is that we're going to get partway open and then we're going to have another big surge in virus infections and deaths, and we're going to have to close. So to my mind, that's the next thing that might send the market down. But my guess is we're just going to see the market going sideways now. I think we're in for a big period of just no happy news and no sort of a sense of no exit by the end of the summer. I hope I'm wrong.
Kiko, on the no happy news front, just looking at what was in the green today. So consumer discretionary and industrials held on to some small green arrows. Some of the real losers in the retail front rebounded today with L Brands and Gap, and also cruise lines here. We've been getting a lot of details out from the retailers this week. And I guess I would say, look, what do you feel? Have you focused on one company in particular more than another, or do you feel like there's a trend that's come out of it that we can extrapolate for? Are we going to be in just this range-bound moment as we're reopening? Like, have we been able to learn anything about Americans' propensity to go back out and start shopping?
Yeah, I think in terms of the trends, it is pretty much what we've been talking about for the last few weeks, which is the shift that was happening in retail pre-COVID is going to continue, except now it's accelerated more online. To that point, we saw the big numbers on online from companies like a Walmart or a Target, but we're also seeing the costs go up, partly because there are measures these stores are going to have to take as they open or more and more people start to come in. And so I think you're going to see that balance even in the big chains or the big winners coming out of this stay-at-home period. They're still going to see a lot of their costs go up. Of course, Amazon, that was a story several weeks ago when we were talking about that. I do want to pick up on a point, though, that Rick was making that I think is really interesting. It kind of ties into what you were saying, which is on the one hand, you are starting to see things return to normal, if you can even call it that, whether it was sort of the virtual IPO today. But at the same time, I think there are other risks that we saw before COVID that are going to start to pop up again. And to that point, we saw the Senate yesterday introduce that bill looking at banning Chinese companies from listing in the US. We had that report from the Wall Street Journal earlier this week in terms of the NASDAQ looking at the same. And so not everything, I think, moving forward is going to be all coronavirus related, but that only complicates the picture for the market because there are so many layers right now.
And I know when we talk about retail, of course, the hardest hit are those in the mall economy, right? And even prior to the pandemic, we talked a lot about the barbell effect, where low-end malls or plazas with the TJ Maxxes of the world and then higher-end malls with the Neiman Marcus's and Bloomingdale's tended to do well. We see both sides of that spectrum getting hit just based on the inability to get foot traffic. We saw Kohl's saying that they're not going to report same-store sales yesterday. And actually earlier in the programming today, we spoke with the CEO of Focus Brands, which owns Auntie Anne's, Cinnabon, Schlotzsky's, and just thinking about all the stores in the mall economy that are not even apparel, that are not even clothing, where there's a forced level of innovation, where these sorts of brands need to figure out where they are going to meet their customer. So the CEO did say that he has actually implemented several pop-up trucks, and it's also cheaper from the upfront cost perspective for a lot of franchisees to, get a truck and go to a college campus. But then again, the ripple effect is, okay, previously college campuses and the food courts there were a great destination for people to, spend their discretionary income on getting a quick pretzel. But now with college campuses, the uncertainty surrounding the fall semester, that's not even a surefire bet. So even these nimble retailers, even these nimble companies that are trying to find new avenues to find their customer are having some trouble here.
Gosh, that's so interesting, because as soon as you said the Aunt Annie's, and I love those, and the food truck, I was like, that's a great idea. But it is this domino effect, right, of everything. And that's just, it goes across every industry. Once you think you have something worked out and you have an idea, just nothing is perfect right now. It's all pretty difficult. Let's get the very latest on the coronavirus pandemic and bring in Anjali Khemlani. Anjali, the headlines from today. Anything good?
Well, once again, no. But so we did talk about in the last hour, really the 5 million mark of cases and how we really do see now, I think, really concrete evidence that this is going to be here for quite some time, barring any sort of progress with the vaccines. And even on that front, what that potential timeline is going to be. Meanwhile, some interesting headlines from today with regard to testing. We've seen sort of a debate growing about how testing should be used, whether or not, antibody testing should be the thing that we rely on as we continue to surveil, the outbreak. And then some headlines as well about what the potential dangers are of combining the results, so not keeping PCR test results and antibody results separate in order to accurately sort of track the outbreak. So we've seen that, really going out. But one thing that I saw that was interesting was a New York Times report in which they were talking about sort of an undercapacity being utilized. And so, we saw how the CDC test had gotten so much attention in sort of that bungled rollout, but simultaneously labs that were preparing to, in fact, see, an influx of testing didn't actually get any. And so even though they prepared and had all the resources available, that shortage of testing that we saw, in part to do with the fact that the CDC rules did say only people who had traveled to China or to Europe at the time could be tested, or only symptomatic people could be tested, or only the most severe cases. Then we saw that shortage of swabs. So all of those rolled together did also play a part, but then there was also this added part, which was, people who could, labs who could test weren't seeing that volume. And now we're sort of faced with a similar thing. It almost seems like there's just one thing after another when it comes to testing. So now the other thing now is, even though CDC has relaxed rules and is allowing asymptomatic testing for that PCR swab test, there are still hospitals, health systems, labs that are really sort of cautious to roll that out large scale, kind of expecting some sort of surge, second wave, et cetera, later in the year, and hoping to just take this time to be prepared for anything like that. So it just goes back to, just another thing we have to sort of wait and watch when it comes to how we're going to continue to do testing in the country. Jen.
All right, Anjali Kamlani, it is always good to see you. Thank you so much for the update. Let's get to our call of the day right now. It's a bullish call from Credit Suisse, initiating coverage on cruises. Yes, cruises, those companies that are down 75, 80%, that were hotbeds of coronavirus. Early headlines, very negative. These stocks have been just hammered. Today, we've got Royal Caribbean with an outperform rating, $67 price target. Norwegian Cruise Line, outperform rating, and a $21 price target. Just pulling up Norwegian here right now. It's about $14, up almost 10%. So all is not terrible for cruises if you read this note. Rick Newman, what did you think?
This is so crazy. I love it. People are going to be cruising again. It's going to go back to normal. I sat here thinking, man, you got to be kidding me. Cruise lines, but their argument is these companies have enough cash to last into next year. That's with no revenue, and that their customer base is pretty loyal. It's a good value proposition. Cruising is cheaper than a lot of other types of vacations. You get a lot for the money. And I sort of scratched my head and sat here thinking about it and thought, I think I'll actually buy that. Now, obviously, if we ever get a vaccine for the coronavirus, that would be the best thing for the cruise industry and many others. But I think their premise here is maybe not a vaccine, but the cruise lines will find people to get people back on the boats anyway. I think it'll happen.
So Kiko or Melody, just raise your hand. Have either of you been on a cruise? I can see you both. No. Oh, and Miles and I haven't been on a cruise either. Wait, Rick Newman, have you been on a cruise?
You're such elitists. I mean, we're out of touch with the people. Come on, we have to acknowledge this. I've never been on a cruise. I've never wanted to go on a cruise.
Wait, Jared has been on a cruise.
I just like to watch.
You've been here. We discussed this in the 3 o'clock. Look, the cruising, it's not as old as you think. 42-year-olds are going. 55% of people that could have gotten their money back because they were canceled because of COVID actually took a credit. So this idea of repeat business, it's a movable asset. You can go around, go to California if the hotspot's in Florida. You've been on one. What do you think of this note? Did you get on?
I've been on two. One was company sponsored, did a sales competition way back in the day. It was kind of fun because I was with my colleagues and they're a lot of fun. Another one might have been the company I was with, but I went to the Bahamas, did not enjoy it that much. The whole experience just maybe I should have gone Royal Caribbean instead of one of the others. But I was thinking when this whole thing broke out a couple months ago, I would do Alaska when the prices come down. I've always wanted to do that. I might do Norway, something like that, but I'm not going to go to the Bahamas.
So, Akiko, you've never been. They need new customers. What do you think of this? No, you're not going, but what do you think of the no? Stocks are down. They're ripe for the picking. People are going to go back, says Credit Suisse.
I want to know how easy it was to get credit for some of these cancellations. That's my first question. But let's talk about this value proposition. I mean, I guess the question is, that value proposition was there pre-COVID. Is value still going to trump safety and concerns in this post-COVID world? I'm not sure about that, and I also look at the numbers that Credit Suisse has put out, 82% repeat customers. I mean, Jen, you said that, they're not all old, right? There are people who are in their 40s that are going, but I mean, isn't the part of growth trying to bring new customers in? And I do wonder how many travelers now, having seen what played out, are going to want to get on a cruise anytime soon. So that's sort of the skeptical take. I have never wanted to go on a cruise. I don't plan to go on one. And I wonder how many new people they're going to be able to bring on board now.
I mean, you got to ask the question, where are people going to travel? A lot of more exciting or exotic travel, you have to get on an airplane. I mean, part of the Credit Suisse case for cruises is that a lot of people can drive to the entry point for a cruise. Honestly, I don't like cruises because I dislike people too much to be around that many people all at once. But if they weren't for that, I might give it a try. If they actually came up with some good offer, I might say, you know what, I just feel like partying. It's been a year of coronavirus lockdown. I feel like partying by the pool. I'll give it a try.
Rick, do you know what that's called? A private yacht. So you just have to find a very bougie friend and get yourself on that.
Maybe I'll have the private yacht by next year, but if I don't, the cruise ship is a fallback.
Yep. I mean, I don't know. Maybe it's the safest time to take a cruise ship. We're all washing our hands so much more.
Well, imagine if you could take a cruise ship the way that people are traveling on airlines right now. Like you have a whole floor to yourself. I mean, they should give that a shot. Maybe that's how they get it started. We're only going to put people in every 10th stateroom, so you don't have to be around that many people. There won't be a line at the bar. There won't be a line at the buffet. You'll have the whole boat to yourself.
I think we've worked this out, you guys. Anyhow, stocks were up big on this note today. Of course, they are still down, on average between like 75 and 80%. So take that for what you will. There they are today, though, some green. Coming up next, we're going to talk about retail. Big week for retail earnings. You know that. Straight ahead, A.T. Kearney lead partner Greg Portell is going to join us, and we're going to go through his scorecard of some of the biggest winners and losers. That's next. Welcome back to the final round. We learned a lot about the retail space this week. Of course, it is incredibly important part of our economy. It tells us a lot about the consumer, their ability to spend, demand out there. I want to bring in Greg Portell. He's partner and head of global consumer industries and retail practice at Kearney. So, hey, what was your most important earnings look that you think we got this week? Because I felt like I was really into what Target had to say, but I also think the home improvement names were interesting. Was there one company that stood out to you and really gave us a roadmap for what's happening right now?
Well, I think it was the consistency of results among those companies that have really invested in the multi-channel capabilities. We've seen companies like Walmart, Target invest in these channels for a while now, and they've never really been put under pressure like they have been in the past couple of weeks. And in both cases, those companies came through with flying colors. So they have a maturity in some of these emerging channels that really speaks well to their capabilities going forward.
Hey, Greg, Rick Newman here. So these earnings results and sales results we've seen lately tell us that shoppers are buying a lot of what they need. That leaves a lot of questions about the stuff they don't need, stuff they might only want, discretionary stuff. What's your read on what's happening with discretionary purchases? Are they going to come back, or are they just going to flatline for some time?
Well, for the past couple of weeks, most consumers were still trying to just figure out how things worked, whether they were learning new channels, whether they were learning new retailers to work with. So the pause in consumer spending over the past couple of weeks is really not something that we would say is an indicator going forward. However, having said that, we do expect that there's going to be a bifurcation of demand. That middle part of retail is really going to be under pressure, where you have something where the consumers either don't quite see the value, or retailers that can't match their value to cost.
Which retailers are you thinking of?
Well, if you're going to be a high-end retailer, you actually have to have the combination of service, capability, product quality, all to match that price point. And I think coming into when we come out of the COVID freeze, where consumers are going to start going into those channels again, the more expensive retailers are really going to have to match that service. And we don't know yet. I mean, the real test is, can those high-end retailers reopen? I mean, why are you going to go to a physical store now unless you're going to get spectacular service?
Greg, we've heard a lot of the big name retailers address the cost issue. In many cases, it's about the investment that needs to go to make sure that there is a safe shopping environment. But I'm also wondering about the wage equation to all of this. Certainly hazard pay, but there's a lot of talk of whether companies are going to start to withdraw that as well. It seems like there would be added pressure on some of these companies to pay more for what we now consider really essential workers. How much of that becomes a risk in terms of an investment side of things?
Well, we were starting to see wage pressure in the sector before the crisis, because the importance of having one continuity of supply of workers, and then also just those that could interact well with the customer service side. The wage pressure was already there. What is becoming apparent is the cost algorithms and the HR management practices of many of these retailers have changed dramatically. Because if you're talking about the need to restock shelves, to greet, to check out consumers, that's a very different labor profile than if you're carrying boxes to cars, than if you're investing in technology to self-serve. The mix of cost is really being changed by the COVID experience.
So, Greg, we got some news today. It looks like Amazon Prime Day, which is usually in July, is shifting to September, closer to another shopping holiday, which is Black Friday. What do you think is going to happen to Black Friday this year? What's it look like?
I think, all retailers, Jen, all retailers are going to rethink these concept of consumer choke points, whether that is the deli section of your local grocery store or large sale events. So in my mind, unless something dramatic changes between now and November, the concept of a traditional Black Friday is dead. We're just not going to see those masses of people in confined spaces for any time in the near future. And plus, if you just look at the way stores are handling social distancing, it becomes completely impractical to do that kind of sale event in today's environment or tomorrow's environment, really.
Will it be virtual though? Or are you saying they don't want to have choke points because they just don't want the pressure of having to be on their staff and their warehouses? Or is it just the people in the store, like just the shoppers?
Well, I think the Amazon decision to delay the timing of Prime Day really does speak to the acute pressure that a lot of these retailers feel. I mean, Amazon's built their model on being able to exceed customer expectations and continue to make things quicker, no matter how much you need or when you need it. But that puts an enormous amount of pressure on the supply chain, the capability, the inventory. And that's not pressure that those retailers need right now. The question is, can they build up enough strength to handle multiple digital choke points in the holiday season? And we're going to find out over the next 6 months whether the retailers are able to handle that.
Carney's Greg Portal, thanks so much for joining us. Great to talk with you. Got some earnings news moving here on a big mover recently, and that's NVIDIA. Miles Udland has the numbers. Miles.
All right, NVIDIA coming out with its latest quarterly report, beating on the bottom line here, $1.80 on adjusted earnings per share, $1.69 is what the street was looking for. Also beating on the top line, $3.08 billion in revenue. The street was looking for something right around $3 billion. Now the stock is down just a little bit in after hours trading, off about 1.4%. For the second quarter, the company sees revenue at $3.65 billion, plus or minus 2%. Now that's better than the 3.2% or $3.2 billion value that the street had been looking for. But they do see a bit of margin pressure in the current quarter. They're looking for gross margins to come in between a range here of 58.6 to 66%. Well, their gross margins in the first quarter were 65.1%. So likely that margins come down a couple hundred basis points there during the current quarter. Again, the stock is off right around 1% right now in after hours trading, but I would note this is a stock that is up 50% so far this year. Its low back in mid-March, right around $200 per share. And in the after hours, shares of NVIDIA are sitting right around 348.
It's not often in a release these days that we get the word excellent. NVIDIA had an excellent quarter. So, I mean, there is the 1-2 punch from this company, as Miles noted, records here for NVIDIA recently. They've got gaming with the stay-at-home trade, and they have the move to cloud by enterprise, and that has really pushed the stock to records, although we are seeing, as Miles said, a little bit of a give back right now. Coming up, a reopening hiccup as Ford temporarily halts production after workers test positive for COVID-19. Could we see more of this happening in the coming months? How will companies handle it? Rick Newman is going to break it all down for us next. Welcome back to the final round. So as states start reopening, people are going back to work. And what we've been talking about all the time is that there needs to be testing there. So what happens when people test positive? Well, Ford is having to deal with this very issue, and Rick Newman's been tracking it for us. Rick.
I think assembly lines are just going to have to deal with this for on an ongoing basis, Jen. So we had a couple of shutdowns at auto factories, as you mentioned, similar to what we've seen at the meat packing plants. And I think part of what Ford and the other auto companies are doing is they're just figuring out protocols. I mean, they're just going to have to figure out, what do you do when somebody tests positive, or can you maybe start doing tests in a way that you identify positive tests before anybody ever gets into the factory? It's just going to be something they have to figure out. There was also a Ford plant closure because they couldn't get parts from another factory, and we're just going to see these cascading problems, slowdowns, shutdowns for a bunch of different reasons for months. I think it's going to be hard to get vehicles off the assembly line for all these reasons.
So is this a story that we should expect to see continuing? Like we're going to see it at different places?
I think it's going to be routine, but I also think manufacturers in the United States will probably get pretty good at figuring out what to do about protecting their workers and keeping operations running, even if you do have these kinds of things. So I think this is going to get a lot better. I mean, we know we're all sort of figuring out the right way to do testing. I mean, testing is just barely getting to the market, so we can do more frequent testing at workplaces. And those of us, by the way, who don't work on assembly lines but work in office buildings, we're going to be doing all these things too. I mean, so in a way, the manufacturers are doing us a favor by being the guinea pigs here and figuring out how we all get back to work.
And we have a guest coming up that's going to talk to us about some of the things that offices are doing. But just on the manufacturing front, what does this, and also I guess I would say in the warehouse front too, in more blue collar areas, do you think that this is going to lead to any resurgence for labor for the unions? Do they have a role here?
Probably not. I mean, look at all the problems we've got. I mean, in some areas, tons of people just don't have jobs. And I'm not seeing anything, any sort of big movement. You know, the membership in labor unions has declined for 40 years. This is a very long-term trend. I don't think coronavirus is going to change that. We are seeing more concern over workers' rights. We're going to see this whole liability issue coming up really soon in Washington. Should businesses be protected from lawsuits if they reopen and their workers or their customers get sick? Congress is trying to figure that out right now. If they push too far and they force workers into dangerous positions, yeah, that could create more activism for worker protections. We'll see. It's possible that happens.
All right, we're going to keep talking about worker safety coming up as businesses are looking to return to the office. Gensler Chicago co-managing director Todd Heiser is going to weigh in on how office designers are responding to COVID-19. That's next. Welcome back to the final round. 3 majors down today, but the Russell eking out a small gain here. Let's go to Jared Blickery with the charts. Jared.
Yeah, the Dow was down about 100 points, and we can see the NASDAQ is off 1%. It was tech was the second worst performing sector next to energy. The S&P 500 down 0.8%, and you can see these indices closing by their lows. As you noted, the Russell 2000 just barely in the green, the outperformer of the day. We've been taking a look at the longer term charts, and we're expecting a breakout one way or another, but we haven't seen it yet, maybe tomorrow. Let's take a look at a Yahoo Finance premium idea of the day, and we are looking at Lowe's companies after just reporting their earnings. And we have a fundamental analysis by Argus Research. They are bullish, and they are they are raising their price target to 140. That is a 17% increase from the current levels. That would be somewhere up here, can't even chart it. And if you're looking to protect yourself, you would probably want to put a stop below the 200-day moving average at 109. This is a long-term opportunity, but it does present a risk-reward ratio of about 1 to 2. So just some notes on what Argus is saying about Lowe's, why they like the trade. Management said that the strong first quarter sales momentum has extended into May as consumers continue to focus on their homes, something that we would find to be intuitively true. The first quarter performance supports our view that Lowe's is well positioned to deliver future post-pandemic earnings growth. We believe that Lowe's shares stand out for diversified investors who are looking for exposure to discretionary retail at financially strong companies. You can sign up for a free trial, 14-day test drive of Yahoo Finance Premium at our website, yahoofinance.com.
Interesting stuff, Jared Blickery. Well, if everybody's at home and shopping at Lowe's, you know where they aren't? They're not at the office. And that's because the office is changing. Goodbye, cubicle. Hello, what? We're not really sure. That's where we're going to ask Todd Heiser. He is with Gensler Chicago, a co-managing director there. Todd, you're a global design firm. You work in offices. I think we all know offices are changing. We've heard stories about the rise of cubicles. Give me a little color of what it looks like. So I haven't been to the office recently. The only place I've been is a supermarket. Do you think the supermarket's going to look more like the office soon with like those aisles you can only go one way, plexiglass? Is that what's coming to my open floor plan?
Well, listen, if anything that 10 weeks actually at home has told us, actually, we've learned that many office workers can work pretty well virtually from home. And so I think while we may see some transfer from any retail or public experience that we've been kind of part of over the last 10 weeks, we might see some glimpses of that in the workplace. But I think what we're going to see is actually a whole new workplace emerge out of this pandemic.
Had to unmute myself there. Todd, I've been struck by, in having conversations, especially with real estate companies, how big tech is likely to play a role. We've heard about the thermal scanners. We've heard about these other devices that track movement to make sure people are social distancing. I mean, that's going to raise a whole host of questions on surveillance as well as privacy. Is that kind of an inevitable shift that's going to happen if we want to make the workplace safe?
Well, listen, I think that tech has always, really for the last 20 years has become a part of workplace. And we've actually seen that emerge from destination dispatch elevatoring to be able to control our environments, the lighting, the HVAC. And so I think that tech is here to stay, and certainly sensoring in the workplace is actually something that is great. But in so many cases, it isn't Big Brother, right? It's actually enhancing our experience as opposed to, an encumbrance.
And then Todd, just thinking about the term co-working that WeWork had heralded, that WeWork had ushered in, and now it's going away. And it was almost the bottom line for me when I thought about co-working is that it was supposed to be a one-size-fits-all model, right? Yep. Everyone wants a communal space. Everyone wants to pay extra if they want to have a private office. How do you anticipate as firms go forward, what's going to be the consumer appetite? What are employees actually craving? Has it been cubicles all along, and has WeWork sort of been a forced ideology upon us?
Sure. So one thing I can tell you that workers are craving, we did a work from home survey, and only 12% of US workers want to work from home full time. And so what I would say to you is, yes, people do want to return to the office, but they actually want to come to the office as a place to come together, a brand and culture hub, And I believe that what we're going to experience is, a different way of working. I think that the office is going to be the place to come together, that cultural center of work. And I think many of the me activities that we associated with the cubicle, the height adjustable desk, the bench, all of those words that you've heard are probably going to be done potentially remote, virtually. And I think we may see less of those in offices.
Hey, Todd, Rick Newman here. Come on, when we really go back to the office, it's going to suck, right?
Well, I don't necessarily know that it's going to suck, but I think it's going to absolutely be different. I think we're going to have to adjust actually some new realities. I think the way that we freely entered buildings is going to change. I think we're going to be more reliant on technology and destination dispatch elevators, as I said, to get up in our buildings. When we get up in the building, I think it's going to be a different experience. I think we're going to actually live in a world that is virtual and physical. I think when we join a call, half the people are going to be remote, and I think half the people are going to be in person. So it is going to be a new normal. I think kind of on the journey when we pulled people out of offices and we actually asked them to go into open plan because of the benefits of collaboration, things that, Gensler has actually studied for many years now. It was an adjustment. And I think truly this will be an adjustment as well. And hopefully on the other side of this, we'll come out with a better workplace experience.
It's a bit of a conundrum though, right? Because as much as these developers do want to really cater to the new way that the office will look like, it's not like they have a ton of cash on their balance sheets to be able to invest in trying to create new spaces. What are your conversations like right now?
Sure. I mean, that's a great question. And I think you're right. I mean, developers, owners, users, tenants, they're all asking questions about what are those changes that they can do in their workplace right now that actually don't require a tremendous amount of capital. And listen, the great thing about the world over the past 10 years is we've been going into buildings and we've been making some huge progress on our HVAC systems, our elevatoring systems, and frankly, in our offices. I mean, I've been doing workplace for my entire career. And I know over the 10 years that I've been doing this, our offices are, many of them are ready for some of the adjustments, the de-densification that we're going to see when we return from this pandemic, COVID-19.
Very interesting. I feel better about the fact that we might actually return to the office at some point in one way or another. Todd Heiser is with Gensler Chicago. He's a co-managing director there. Thanks so much.
Thank you.
Coming up, the coronavirus is hitting Michigan businesses hard. We're going to talk to someone on the front lines right after this. Welcome back to the final round. So President Trump was in Michigan today. It's a really important state for his reelection. It's also been critical and front and center in the debates that have been going on over reopening. I want to bring someone in now who's in Michigan on the front lines of economic development there. Glenn Wilson, he's the president and CEO of a Flint economic development nonprofit. It's called Communities First. Glenn, welcome. I want to start with what is it like right now to be operating a nonprofit? And I have to say, I mean, often when we have stories about Flint recently that have been in the news, I mean, it was the water crisis first, and now you're dealing with COVID-19. How is it operating a nonprofit there?
Well, I think it's not just unique to Flint, but I think, just across Michigan and across the country. I think people right now are looking for ways to remake themselves as organizations because you're so used to having touch, with an individual one-on-one. Nonprofits are used to addressing needs, which has to deal with dealing with people on an interactive basis. And it's how do you provide high quality services to those same individuals, but now doing it more remote and being able to have the resources as a nonprofit to be able to make the shifts necessary that you need to be able to meet the demand that's needed within any community.
Hey, Glenn, Rick Newman here. There's been a lot of attention focused on Michigan with the protests in Lansing and other things like that. So my question about the shutdowns there, do business owners in your area feel like the shutdowns are appropriate to get the virus under control, or do a lot of business owners think they go too far?
I think it depends on the industry that you're in, right? Some people are going to think it goes too far. Some people are going to think that things are great. I think it just really depends on the industry. For one particular industry like landscaping, landscaping was a big thing here where the governor just reopened it probably about a week and a half, 2 weeks ago. Construction, which is another area that we're in, it was finally opened up about 2 weeks ago. And some people felt as though construction should have been, left open as being deemed essential, and it possibly wasn't. However, there are some people also in the construction world that felt as though we need to get more things in order. It gave companies time to get resources in place and to put protocols to get these businesses back open again. So I think it's just a big mixture. It depends on the business that you're in the industry, whether if you're a food business, because imagine if you don't have a takeout business and you're a restaurant, are you able to get your business able to do curbside service? Do you have the capacity to do that? Do you have the online systems? So it's vice versa. Some people think it's a great idea. I've heard mixed feelings on both sides. And I can understand both, because you have to make you have to make a living, right? And you have to figure out the way to do it. But, me personally, I'll just say, I don't think it should be done at the cost of individuals' lives. However, it has to be done in a proper order and have proper protocols to be able to backstop the effects of COVID.
Glenn, we've seen a lot of states and cities throughout the stay-at-home period move to ban evictions and also allow for a deferral of rent. At some point, that rent is going to be due. And I'm wondering, as somebody who is really trying to tackle the issue of affordable housing, what's going to be the impact on that front? And then the knock-on impact from that, homelessness.
Yes, absolutely. So when it comes to the affordable housing piece, there's a couple problems. And I'm not going to say problems. I guess there's always an opportunity to fix things. But one is you had, federal resources that came available to try to get people housed. But the issue is you did not have a lot of quality housing stock for people to move into. So you have all these individuals that were homeless when everybody found out, oh, shoot, there's nowhere for people to place their heads when you say go home and have a stay-at-home order. And then you have shelters that are understaffed or might be or don't have the resources, or developers don't have the units available. Is how do you put, when they say that square peg into that round hole? They don't fit together. So it's about having not only looking at things to have prevention, but also looking at ways of how you can also help the service providers that are here that's needed now. I think it put homelessness on the forefront to let people know when you said go home, that doesn't mean everybody had a place to go and lay their home. So hopefully things are looked at a little bit differently. Hope there's more resources that are provided throughout the provided throughout the country to make sure that we can end this homelessness across the United States.
Glenn, I love your optimistic tone. You've used the word hope a lot, which I think is very vital during this time. Have you received financial support, whether it's through the PPP or other mechanisms during this time? Tell us about your finances.
Yes, absolutely. I mean, as a nonprofit organization, I mean, you need resources and you need finances to be able to run your operations. We have received the PPP, but the PPP is limited to the 8 weeks that you have for the staff. As an organization, this is actually our 10th year, and us having a 10-year as an organization, we had to cancel our 10-year fundraiser, our 10-year gala that we were planning on doing this year to celebrate a decade of serving our community. So yes, the 8 weeks was great. However, a lot of nonprofits, not only just us, are being impacted across the country, across our community, and there's definitely more resources that are needed to be able to fill those gaps. Because who's going to want to sit in the gala a week, 2 weeks from now and raise money, to help individuals and get a plated meal is just not going to happen right now. So we have to get creative on ways on how we're going to raise new funds to be able to cover these gaps. But just like right now, to give an example, we've had a gap of about 450 to a little over $500,000 in a financial gap this year just because of COVID for things that we were anticipating that we will no longer be able to do. So it just gives you an example of, how do you take an organization that has a pretty good budget and then you lose a quarter of that just in a matter of a month.
Communities First President and CEO Glenn Wilson, thanks so much and happy 10-year anniversary.
Hey, thanks a lot. We greatly appreciate you having us on today.
Yeah, it was good to get a chance to talk with you.
All right. Thank you very much.
We'll be back with much more Yahoo Finance in 2 minutes. Welcome back to the final round. A little bit of a down day here on Wall Street, although the Russell peaking up. I lose track of the calendar here. Tomorrow is the Friday before Memorial Day. Miles, do you think it's going to be slow?
I suspect it'll be slow, although, maybe there'll be a little bit of volatility ahead of the long weekend, though I don't think many people really feel like it's a holiday, right? Because every day is kind of the kind of the same here, in these times. But I will not be here tomorrow. You will be here tomorrow, Jen. Before I go, I'd just like to say, you're not leaving Yahoo, but there will be a new adventure for Jen Rogers starting next week. And I would just like to say it's been a distinct pleasure and an honor to do this show with you daily since 2018. Thinking about it, we've done it every day. So it's been quite a ride. I didn't foresee us moving to Google Hangout and then doing it in a distance quarantine way for a couple of months. But, them's the breaks. So see you around.
I will see you around. It's been great, Miles. I've enjoyed every minute of it. I was going back and do I have to rap? Did they just say that? I'm going to be like Julia Roberts and say, forget it. I was looking back, and if people had bought stocks when we first started, they'd be doing pretty well. So you can take that and go with it. I guess I'm not Julia Roberts and I actually have to rap. Anyhow, one day I'll see you, but have fun golfing. That's it. I will be here tomorrow. We've got a Hollywood special. We're going to be talking about Hollywood getting back to work. See you guys then.
Warren Buffett needs little introduction. He's the godfather of modern-day investing. For nearly 50 years, Buffett has run Berkshire Hathaway, which owns over 60 companies like GEICO and Dairy Queen, plus minority stakes in Apple, Coca-Cola, and many others. His $82.5 billion fortune makes him the third richest person in the world, and he's vowed to give nearly all of it away. The Oracle of Omaha is here to talk about what shaped his investment strategy and how to master today's market. I'm Andy Serwer. Welcome to a special edition of Influencers from Omaha, Nebraska. It's my pleasure to welcome Berkshire Hathaway CEO Warren Buffett. Warren, welcome.
Thanks for coming.
So let's start off and talk about the economy a little bit. And obviously, we've been on a good long run here.
A very long run.
And yet, does that surprise you? And what would be the signs that you would look for to see that things were winding down?
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers, so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses, what those numbers tell me. They're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. We care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom, on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
Fair enough. You have over $100 billion of cash.
Berkshire does.
Berkshire. No, well, I don't even see how much you got. Maybe you do. Berkshire has over $100 billion in cash, and you say that you always want this company to be a fortress. So how much cash should an ordinary investor have on a percentage basis, do you think?
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of, you need any cash.
So you can be more cash-free than Berkshire is.
Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that, would happen. All kinds of things where we might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children were growing, the house was paid off and everything. But, I wouldn't worry too much about having a lot of cash around.
Let's talk a little bit about Apple. Everyone always wants to talk about Apple, right? It's kind of the it stock, it company. You have a $45 billion stake, more or less. How closely do you follow the company? People are concerned they haven't really introduced any new products.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No. If you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once. It doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good, and some when the prices aren't going to be good. I know there's years when yields will be better than others. But I bought the farm, and it just doesn't. I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre, and now in a good year, it'd be 200. We've really made progress in this country. That's one reason commodity prices, if you go back a couple hundred years, they've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that.
And so Apple is kind of like a farm.
Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and you had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
Let's switch over to talk about buybacks, which is another hot topic these days. And you did a fair amount. If you look in the annual report, you can see that between December 13th and 24th, it looks like you guys bought back about $233 million worth of Berkshire, which was right near that particular stock market bottom. How did you know that? Or what was going through your mind?
If I knew it, I'd have bought a lot more than 200. No, that's not a big purchase for us, actually. And now we will buy Berkshire when we have lots of excess cash. All the needs of the business are taken care of. We spent $14 billion on property, plant, and equipment last year, way more than depreciation. So we take care of the needs of the business. Then we have excess cash. And if we we'd love to do is find other businesses to buy. But if I think the stock, and my partner Charlie Munger think the stock is selling below intrinsic business value, we will buy in stock.
So it obviously was at that point.
Well, we thought so, yeah. But what's really intriguing is when it goes down a lot. When you're buying dollar bills for 60 or 70 cents, which periodically you get a chance to do in stocks, then assuming you've got the cash, you don't want to ever get so that some surprise could really take you out in some way. But if we've got excess cash, we'll buy it as fast as we can.
But at that point, it would be more like a 2009 rather than just December of this past year.
Exactly.
Right.
But it's, if you and I own a McDonald's franchise together and it's worth $1 million and you own 50% of it and you come to me and you say, I'll sell out for 400,000, I'll buy you out.
If you say want to buy mine, I'd be wary of that, but for just that reason.
You should be, yeah. But if you want 600,000, I'll just say, come back tomorrow.
So just continuing about buybacks, Senator Schumer and Sanders want the government to weigh in to sort of legislate when companies can do buybacks. And then also there was a report recently about executives doing insider trading, it appears, around the times of buybacks. So are buybacks a kind of a problem?
Well, you'll have some people that misbehave in respect to any activity. So it really wouldn't have much to do with buybacks. I think buybacks, the degree to which they've been part of nefarious activity, and I've observed them for a lot of years, are very close to zero. But that just may be that there aren't enough opportunities. But that article did not. I didn't follow the conclusion on it. I mean, you're distributing money to shareholders. Essentially, you can do it by dividends, and presumably American business should distribute money to its owners occasionally. And we do it through buybacks, or we've done some, and we don't do it through dividends. And but most companies do it through having a dividend policy. And then if they have money beyond the needs of the business, then I think if their stock is underpriced, then it makes nothing but sense.
Should the government tell companies when to do it, or at least mandate conditions where they can?
Well, they do restrict you a little in terms of if you're some general rule of the SEC, if you're having some kind of this isn't quite the right word, but manipulative activity or anything like that in the stock. But no, I don't think the government should decide your dividend policy. I don't even think they should direct your capital investments. They can make it enticing to make certain kinds of capital investments, which they do with renewable energy, for example. I mean, the government has interest in fostering certain developments in this country over time, and they do. There used to be a special oil depletion allowance, 50 years ago and so on. That was more politics than it was governmental policy, but certainly renewables are a prime example of that. But the idea of directing whether you are entitled to return cash to shareholders and the manner in which you do it, I don't think really makes a lot of sense.
The 2020 election is going to be upon us before we know it. And I know that you had some nice things to say about Mike Bloomberg, but it appears he is not going to be running now.
Yeah, it's hard to win with just a billionaire vote.
You would have your vote and a few others. That's funny.
But I admire him enormously. I wish he had run. I want to be very clear on that.
President Trump was a business executive. So 2 questions. Is a business executive the right kind of person to be president? And what characteristics do you look for a president that you would support?
Well, I think a business executive can be the right person, but I don't think that because they're a business executive that you give them extra points. And number one, I want a president that wakes up every morning and realizes that the greatest threat to a country which has got all kinds of things going for it are weapons of mass destruction, and that we live in a world where people, organizations, and occasionally countries could have people that would like to wipe out a large percentage of the American people, or maybe other countries as well, and that you now have capabilities which I always thought until recently I classified as nuclear, chemical, and biological, but I think you have to add cyber now. If you have some evil genius someplace that for crazy reasons, just like happened with anthrax back, who knows what motivates somebody that starts sending anthrax out in letters. And if you have somebody that thinks that it'd be great to send a false alarm to the Soviet or to the Russians and to the U.S. that the other side was launching or something of the sort, it's a very, very dangerous world. It's a wonderful world, but it has dangers now that started in August of 1945, and when Einstein said, this changes everything in the world except how men think. So I want a president that has that same filter, that all of these other things are important, but protecting the country and reducing the chance of successful use of weapons of mass destruction against us is the number one job. And I think most of the presidents, I've talked to a couple of them about it over the years, and I really think that they do realize that they may get lost in the events of every day as they go along. And then beyond that, I want a president that has 2 objectives with the economy. One is to make sure that this marvelous goose we have keeps laying more golden eggs. And then I want a president that also feels that if GDP is $60,000 per capita in the United States, that nobody should get left behind. We've got a market system that works marvelously in turning out more goods and services, better ones, year after year. Done it all through my life.
Would you ever talk to a candidate and say, hey, what do you think about these 3 things?
Well, they'll tell me what I want to hear. So I want to hear what they tell people who disagree with them on the subject. I always like to ask a candidate, they usually finesse me some way or another, but I say, what are you for that the majority of your followers are against? You know, I know you really believe in that, you know, and that's really the test, but I'm not sure that, except under some kind of sodium pentothal or something, you're going to get a great answer to that question.
That's great, but that's the question you ask the presidential candidates or presidents that you would speak to.
If I really want to get, and that's why Bernie Sanders was so successful. I mean, 90% of the people who voted for Bernie Sanders had probably not heard of him 2 years earlier, but they felt they knew exactly what he would do. I mean, they felt he was authentic, and if you asked him, you know, what he was for that most people might be against, he would tell you, you know.
A few questions about Kraft Heinz. Was that a mistake?
Well, we'll find out over time, but we did pay too much, in my view, for Kraft. We didn't pay too much for Heinz. So when we started out, it was originally a non-public partnership between us, but we did pay too much, in my view, for Kraft. And there's not much you can do on things if you pay too much. Secondly, there's always been a struggle between the retailer and brands. I mean, if I've got a terribly weak brand and I want to get into Walmart, I'm not going to be able to do it. You know, I mean, I have to offer all kinds of crazy concessions, you know, and I want to be in Walmart if I have some sort of consumer packaged goods. The negotiation is way different if you have something essential versus non-essential. 10 years ago, Costco tried to get rid of Coca-Cola. Costco's got terrific loyalty among customers, and you know, and their own Kirkland brand is a $39 billion brand now, and it moves from category to category, and they only started in 1992. So they know brands, but in the end, they put Coca-Cola back in. If it had been Royal Crown Cola, they wouldn't have had to put it back in. So there's always that struggle between the brands. I mean, and there always will be. But the retailers net, it has been moving in their direction, particularly, I think, because of the Amazon revolution.
First Walmart, and then
Walmart.
Right, and then
Walmart.
Amazon.
Yeah. I mean, but it's been accentuated. Yeah. I think we have a new retailing environment now. I mean, it isn't like it goes from night to day, but it moves somewhat, and brands that people have spent billions of dollars developing and sponsoring TV shows or sponsoring radio shows in the old days. I mean, Campbell Soup was always on there with Jack Benny or something, you know, when I was a kid, and it was big, and it built brands, and people obviously like the product too, but people are more willing to change, and it's harder. It's a somewhat different world than what. It is night and day. I mean, you are very unlikely to keep changing brands every day. But it really surprised me that Gillette lost position. I mean, men don't like to experiment much. Women are better experimenting. But you know, when you were a kid, the Gillette cavalcade of sports was your pal and brought you the Rose Bowl and, you know, the World Series and all that sort of thing. You just shave with Gillette the rest of your life, and you still do to a great degree, but it's not exactly the same as it was even 5 years ago or so when we bought Kraft.
You mentioned Amazon as a game changer, and I have to ask you, you haven't bought the stock. You're an admirer of Jeff Bezos. A listing of the richest people in America came out. He's number one. I think your friend Bill Gates is number two. You're number three. So you can see what he's done in myriad ways. Yeah. And of course, the question is, how come you haven't bought Amazon? Is there still time to buy? Would you still buy?
Oh, I always admired Jeff. I mean, I met him 20 years ago or so, and I thought he was something special, but I didn't realize you could go from books to what's happened there. No, I mean, he had a vision and executed it in an incredible way, something that it would not have, you know, but there's a lot of games I miss. I would have missed Microsoft even if I gotten to know Bill earlier or something. Those just aren't my games. I don't worry about the things that I miss that are outside my circle of competence of evaluating. I have missed things that were within my circle, and that's a terrible mistake. Those are my biggest mistakes. You haven't seen them. But I don't, it's not a mistake because I miss Netscape or something like that at all. I would say that maybe 5% of the companies or 10% of the companies at most are within an area of my circle of competence. There's something I should be able to understand.
All right, well, let me switch gears then and ask you about leverage a little bit. And corporate debt, people are concerned about. People are concerned about federal debt at $22 trillion. Should we reduce, let's just say, the federal debt, and how would we do that?
Well, if you're running a deficit getting close to 5% when things are really good, that's a new world. And nobody's, neither the Republicans or Democrats are particularly concerned about it. And we're not having a lot of inflation. That wasn't supposed to happen, but it's happening. That's why I say you don't want to get hung up on trying to make economic analysis because nobody's any good at you don't get rich doing that. If you look at, you mentioned that Forbes list, if you get on the list, the number of people have done that by economic analysis, I think you're just about zilch on there.
Okay, fair enough. Income inequality, wealth inequality, you've talked about the earned income tax credit. Is there more to it than that? Should we adjust tax policy? It seems to be going the other way right now.
Well, it is going the other way, but I think the earned income tax credit is the best way to put money in the pockets of people that don't fit well into the market system, but that are perfectly decent citizens and that have made a good bit of the success somebody like I've had with Berkshire or something possible. It wouldn't have happened without the America we have. And if you go back 200 years and we're all working on, 80% of us are working on farms. The person that's the best at that, working on that farm, whatever it may be, is worth maybe twice the ones that's the worst. I mean, that's the difference between super talent and no talent in the farm economy, picking cotton or whatever it may be. Now, if you're the best middleweight fighter in the world, you may get $20 or $30 million. And if you are just a good citizen, raise nice kids, help in the neighborhood and everything else, but you don't have market-related skills, you'd be good on that farm still. And you would be earning something comparable to most of the people around you. But you don't have something now that as it gets more and more specialized, and it's going to continue to get more specialized. You want two things for that person. You want them to have a decent life. I mean, they live in a country with 60,000 of GDP per person. You want them to have a decent life, and they can. I also think you want them to have a feeling of accomplishment. So you want them to have a job, assuming that they're not handicapped in some way. You want them to have a job. But the minimum wage would be one way to say, well, we'll make sure that they have enough money in their pocket. But that's got a lot of effects in disturbing the market system. They just need more cash. They don't need a higher wage. They need more cash in their pocket. And the government, at a relatively low cost, can provide a decent living for anybody that's working 40 hours a week and has a couple of children. And we've gone in that direction, and it's sort of bipartisan. I mean, you find both Republicans and Democrats for it. I think it would be better not to have one annual payment, that they get it monthly. And I think there's various things you could do, but you want them to feel part of the system, and you want to have them get as more and more of these golden eggs are laid. You want them to get a little more of their share.
I mean, if we don't do that and the Democrats win, it's possible we get big taxes on wealthy people, free college for all, and those are bigger plans.
You want more money in the pockets of everybody that's willing to work or is unable to work. And we can do it. A rich family would do that. If I had 6 or 7 kids and I had some business I wanted to pass on, you'd pick the most able person to run it because that's the market system to do that. But you'd make sure that all 7 of the family participated. You'd give more to the one that didn't. You might give more to the one that kept producing the golden eggs. You would, but you wouldn't just say to the one at the lowest end, who might be the best kid of all in most respects, he's the one that shares with everybody and does all kinds of things, and you wouldn't say to that him or her that, too bad, but that's just the way the market system works, that, go have your spouse get a job and look for housing someplace.
Right. Why don't we do an update about the healthcare initiative, which now the company has a name.
Yeah,
Haven. Was that your idea?
No.
Sometimes
I didn't worry about a name. We could have gone on as a no-name operation for 10 years, as far as I'm concerned. No, that is, we got a wonderful partnership in the sense that it's large and has reasonable market muscle with more than 1 million employees among the three of us. We've got 3 CEOs that can make things get done in organizations that are so big that normally they wouldn't get very bureaucratic. If you tried to do this with many big companies, you'd have legal weighing in and public relations weighing in. We don't have any of that stuff. They may have them in certain areas, but I don't have to. But Jamie isn't going to worry about doing that sort of thing, and neither is Jeff. So we've got a unity of commitment and an ability to execute on the commitment. The only problem is you've got a $3.4 trillion industry, which is as much as the federal government raises every year, that basically feels pretty good about the system. As we went around talking to people to find a leader for the group, for example, everybody says, the system, it turns out very good medicine, but you can't go from 5% of GDP to 18, without really making you less competitive, among other things in the world. So everybody thought the system needed some adjustment, just not their part of the system, and that's very human. I'd do the same thing, I'm sure, if I was in the same place. So there's an enormous resistance to change, while a similar acknowledgement that change will be needed. And of course, if the private sector doesn't supply that over a period of time, people will say then, we give up, we got to turn this over to government, which will probably be even worse.
How often do you talk to Jamie and Jeff about it? I know Todd Combs, I think, is your point person.
Todd really does all the work at our, but if this works, give Todd 100% of the credit from the Berkshire standpoint.
Does Haven have to buy companies to gain expertise? And what do you?
No, no, I don't.
What is the plan? I mean, how do you?
The plan is to support a very, very, very good thinker on this subject is a practicing physician and who commands the respect of the medical community to, in effect, figure out some way so that we can deliver even better care and have people feel better about their care too. I mean, they have to perceive that they're receiving better care over time and stop the march upward of cost relative to the country's output. We've got this incredible economic machine, but we shouldn't be spending 18% when other countries are doing something pretty comparable in terms of doctors per capita, hospital beds per capita, and all that. The very top stuff in medicine, I think, is very much concentrated in this country, and that's great. I want us to be the leader, but I think we're paying a price. If we're paying 7 extra points of GDP, that's $1.4 trillion a year.
Is the administration focusing on drug prices? Is that sort of a rabbit hole? Is that missing the bigger picture?
I mean, they're trying, and Congress generally. I mean, if you talk to the average congressman, they regard it as a problem, and they see specific instances, of drug prices or something like that. But it's a big problem to change. I mean, the trouble is it intersects in so many ways, and that's why we've got Gawande heading it, and we've got 3 biggest size organizations backing him. We're not trying to do it to make money. I mean, that is not a goal that we end up with some business that we make money off of.
And will he be talking to health insurers, for instance?
Well, he'll be talking to everybody, but it is his game plan is not something we're going to try and lay out because it's in his head to some degree. I mean, obviously, we selected him by hearing and reading and so on what he's done. But he'll learn as we go. We will conduct certain experiments, or he will, and try out a community where one of us has a lot of employees, maybe, and there's various ways to experiment.
Shifting gears, where do you find things like that Abe Lincoln tail and leg quotes? I mean, do you read Bartlett's book of quotations?
No, I don't read, but probably 50 years ago, I looked at a few Bartlett's quotations, but I read a lot, and
you just remember these things and apply them?
Well, if you're 88 years old, I mean, you ought to remember something. Oh, you don't remember what happened yesterday, but you remember the old stuff. You've got a lot of interesting quotations in your head,
Not like you do. I think that's great. Okay, so one company you invested in was GE.
Yeah,
and you did well with that investment. And
yeah, I was too early actually. If you look back, I was very active in the last half of September and early October, and then I wrote that article in later October, and I knew it was going to get bad. I wrote the article was going to get bad, but I didn't think the stock market would react as much as it did between then and March. So I had more or less used up our powder well before the bottom was hit.
It's interesting. How have you avoided not getting back into GE more recently? I mean, I'm sure that they've reached out to you. Everyone says, why doesn't Warren Buffett invest in GE and save it and take it to the promised land? It's this great American company.
Well, actually, I think Larry actually is doing a good job.
Larry Culp.
Danaher, yeah, Larry Culp. But Danaher is a good sale. And I think his priorities are straight, and I think he's a very able guy, and he's on the right track. And I'm a fan of GE's in the sense that we're a big buyer from them, we're a big seller to them. I've known the managers. I mean, Jack Welch is a very good friend of mine, and we don't agree on politics 100%, but we have a lot of fun together, and I love the guy. So I've got a great desire for GE to do well. It just hasn't looked that attractive to me.
Right. You talked about the groves of trees in the letters shareholder. One was the third grove, which was sort of the in-between stakes. The
equity interests.
Yeah. Is it the case that those are sort of not the healthiest grove of trees? And why would that be?
No, those Pilot Flying J is they're companies that under GAAP accounting we have to record under an equity method. We own more than 20%, but we don't control them, and so it's treated under GAAP accounting as a special category, and it didn't fit well in the other grove, so I had to make it a separate grove by itself. It's not that significant a grove.
You say that the sum of Berkshire has a greater valuation than the parts.
That is true.
Did you ever try to calculate that? How much is that?
Well, it depends on circumstances. I mean, there's sometimes when the float from insurance can be very valuable. There's sometimes when the ability to use production tax credits, we'll say, in the utility business, but have them on our as part of our consolidated return helps. But that varies a lot. But it is a plus, and we can move capital. Well, take a business like See's Candy, which we bought 40 odd years ago. It's a wonderful little business. It throws off capital. We've tried 50 different ways to expand geographically, do all kinds of things. It doesn't work, and we'll try it again, and it won't work. But we can move that capital to help buy BNSF Railroad or do all kinds of other things. So we've got a seamless and tax efficient way of moving capital where it's needed. And we've got some companies that really chew up capital, and we got others that kick it off, and we can move it from one pot. If you try to do that with your investments, you incur some taxes as you go along doing it, and it's less efficient than what we've got.
You talked a lot about the tax cuts and the benefits to Berkshire. You didn't really get into the costs of the tax cut, which surprised me a little bit. Are there costs? I mean, is it just free money?
Well, it makes a difference. The tax cut we get, for example, our utilities, as I mentioned in the report, that goes to the customers. That's just the nature of utility regulation. But net, we were a significant beneficiary from the tax cut. I mean, basically, let's just say we had one class of stock, we got two, but stock, you and I own a business together, and we think we own all the stock, but the truth is, before the tax cut, the government had a 35% share of the stock on income. Now, I didn't have a share of the assets, but it had a share of the income. And if it wanted to change it to 40, it could have changed it, but fortunately it changed it to 21. And if we had a private business, if we had a McDonald's franchise together, or an auto dealership together, the third shareholder, that invisible shareholder, the government, just handed us back a bunch of the shares of stock, and our shareholders benefited, and a lot of other shareholders benefited.
Right. You talked about Ajit Jain and Greg Abel saying that Berkshire blood flows through their veins. Have they made a difference since they become vice chairs? And then are they like Warren and Charlie?
No, they don't have the interaction. They each run a separate business inside. Ajit does not think about the other businesses. He thinks about the insurance business, and Greg does not think about the insurance business at all. And I think about the money and the capital and so on. But they're running two very big businesses. I mean, Ajit's business, has, you get all told, at least a couple $100 billion of assets, and Greg's business has $150 billion of revenues. I mean, they both would fit up there toward the top 10, or so in the country in terms of value. So maybe the top 15. But they're very big businesses.
But they're not exactly like you two guys. It's not.
Oh, no.
Right.
Charlie and I have a partnership thinking about the whole place,
Okay.
and we've done it forever, and we still do.
And Todd and Ted? I didn't see them mentioned.
Well, they have $13 billion each, including pension funds that our pension funds that they run, and so of the $173 billion we had at year end in equities, we had 173 bucks. We had another $8 billion in pension funds. So of the 180 or so, they had 26 between them that they're managing. They got total discretion on that. They don't ask me. At the month end, I look and see what they did. They don't do much. They don't do a lot of trading or anything. But I look to see what changes they made. And Todd, for example, I mean, he made a couple of small investments in private placement type operations, and I know what the businesses do, but I can't tell you their names. That's his baby.
Was one of those, you made this investment in Oracle and then you sold it. Was that something they did?
No, that was not something they did. That was something I did.
Yeah, and you said you didn't understand it. That's why you sold it. But then why'd you get it in the first place?
Yeah, well, that's a good question to which I do not have a good answer. I know. I see development. I know enough about the cloud to know I don't know enough about the cloud.
Right. Okay. So Barclays put out a note. They said they were lowering the estimates for Berkshire for the EPS. Do you read that stuff?
No. Well, I may read it accidentally, but I don't seek it out to read. I'll put it that way. But it just doesn't make any difference. I mean, if I spent time reading that, I wouldn't have time to read 10Ks. And we're not going to do anything different. I don't know what we're going to earn. As I put in the annual report, and I really think this is unique. I mean, we do not prepare financial statements monthly for Berkshire, and there's just no other company would do it. But there's no sense doing it. I know where the money is, and I know how the companies are doing generally. But what difference does it make? Because I'm not going to try and hit any number for the quarter by, having a sale on insurance or doing something even worse. So And Charlie, I mean, he knows where we stand, and we know what businesses are doing well, which aren't, and we certainly know where the money is.
Another one, UBS survey of Berkshire investors says the 5 most important things to them are succession, investment performance, M&A opportunities, share repurchase, insurance margins. Do you read that, or does that
no,
surprise
but
you?
I don't disagree with that. I mean, I'm glad that somebody understands this.
Your own investors.
Yeah. Well, that's important. 54, well, if you go back to when I started my partnership in 1956 that Berkshire came out of, there were 7 people sitting there at a table having dinner. relatives primarily, and I said, here's the partnership agreement. It's done under Nebraska law. It's 4 or 5 pages. You don't need to read it. But I said, here's a little half-page, what I call the ground rules. And I want you to read these. And if you feel okay about that, about the interaction, what the expectations are, and all of that sort of thing, then we'll join forces. And if you don't, it's fine. Other people have, but we shouldn't be partners. I mean, if I'm going to have a partnership with somebody, I want it to be compatible. It is, and when you have a public company, you can't control who comes in. I can't control some guy that comes in and thinks we're going to pay big dividends or split the stock or something like that. So by my actions and my communications and everything, I want to attract the people that from the public market that I want, and I want to keep the others away. Costco was built. Saul Price, who started the Price Club and that thing, he sat down and figured out the customer he didn't want. And he set up a system that would keep away the customer he didn't want. Who did he not want? He didn't want somebody buying a quart of milk with somebody behind him with a basket of $200 worth of goods waiting for that. So he put in a membership fee, and by putting in a membership fee, he killed all the drop-in business, the business that belonged to the 7-Eleven. We want Berkshire to keep out people who have expectations about us that are different than ours. I mean, good for them, and I hope they find somebody they fit. But if you're going to run a church, you want your seats to be filled by people that are generally want to listen to your form of religion, and you don't want it to change every week and say, gee, I need a new group, and I'll go out and talk to a bunch of investors and get them to come to my church this Sunday, because there's only so many seats in the church. There's 1,645,000 or so A equivalent shares, and those are the seats, and I want them occupied by people that are on the same page I am.
The Church of Berkshire. Seems like you've got a big weighting in financials, and of course you finally invested in Jamie Dimon's company. Why banks right now?
They're businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right. And I don't think they will turn out to be the best investments at all of the whole panoply of things you could do, but I'm pretty sure that they won't disappoint me.
Is climate change changing your insurance businesses?
No, it doesn't change the insurance business.
Does it change modeling or something in the business?
No, it would change our insurance business if we were writing 20-year policies. I mean, if there was something that changed life mortality adversely to the interests of a life insurance company, you're stuck with a policy for 20 years if you write the life insurance policy, and you'll keep paying your premiums if it's adverse to me. That's what's happened in long-term care insurance, for example. But when you write a policy for 1 year at a time, you see what the developments are, and if cars, for example, are much safer to drive than they used to be. There used to be 15 deaths per 100 million miles driven. Now there's a little over 1. On the other hand, they've become much more expensive to fix. I mean, that little side view mirror, which used to cost $10, now $1,000 or something like that. So you have things that are changing in terms of, if you're writing collision insurance, you got to allow for the fact that windshield, the bumper, all kinds of things, or the side view mirror and all that are way more expensive. But if you're writing liability, you know that people aren't going to die as often. So climate change is climate's been changing, but the truth is that you now can buy really big catastrophe limits cheaper than you could buy them in 2005 or thereabouts, allowing for changes in the dollar and concentration of population. So far rates have come down. That's the reason we've gotten out of the cat business to a great degree. We were a very big writer of cat business 10 or 12 years ago. We aren't out of the cat business because of climate change. We're out because the prices aren't right. And the world will change, and that's got very serious consequences, but it won't change that much from year to year. That, we've done very well during a period of some climate change.
You've talked about technology advancing faster than our ability to understand it. And I'm wondering if social media and Facebook and Google and Russian trolls coming in. And is that maybe an example of that? Or are you still worried about that problem?
Well, I think cyber poses real risks to humanity, forgetting about the problem of even misinformation. I'm just thinking of, we have railroads running over 22,000 miles of track, and some of them are carrying ammonia, and some of them are carrying, chlorine and things. We have to carry them. We have no choice about that. We're required by law to carry them. And I would rather do that in a non-cyber world than a cyber world. And there are all kinds of things. The problem about something like cyber is that it's moving, and it's just unpredictable whether you'll get some crazy guy like stuck the anthrax in what they can do becomes magnified. I mean, when you saw what 19 guys did, on 9/11. I mean, tools in the hands, or potentially in the hands, of either crazy individuals, crazy groups, or even a few crazy governments, are really something. And we don't necessarily know what all the tools they have are, and that is moving all the time. I mean, again, Einstein said, "I know not with what weapons World War III will be fought, but World War IV will be fought with sticks and stones." I mean, it's a dangerous world.
I don't know if you've been following this, Warren, but what do you think of Elon Musk's behavior as a CEO?
Well, I think it has room for improvement. Now, he would say the same thing. I mean, it's just some people have a talent for interesting quotes, and others have a little bit more of a blocker up there that says this can get me in a problem. But he's a remarkable guy. But I just don't see the necessity to communicate. I think I've got 7 tweets because a friend of mine signed me up for it, and she's called me about 100 times saying, "Can I tweet this or that?" And I've said yes to her 7 times, I guess, or something like that. I've never actually written one myself. I don't even know how to do it.
Have you talked to Elon ever?
He joined the Giving Pledge, so once or twice, but that's a lot of years ago. 7 or 8 years ago. He hasn't come to our annual gathering, so I haven't seen him for 7 or 8 years.
So let's talk about this trade war that's been going on a little bit with China. And I guess I'd like to ask you, do you think that Donald Trump was right in calling out the Chinese government and basically putting them on notice?
I won't have any comment on that. In terms of political activity, I don't put my citizenship in a blind trust. So when the election comes around, I'll do something. On the other hand, people will interpret things I say about any president, as to some extent coming from Berkshire, and they don't come from Berkshire. I'm just an individual, so I think. I'm glad to talk about China, but I can't talk to you about that part of it.
Fair enough. I mean, do you think there was room for improvement then in terms of the trade relationship between China and the United States?
Well, I think that China and the United States absolutely are destined to be the superpowers, beyond my great-grandchildren lives, and will always be competitors, and will be competitors in business, we'll be competitors in ideas, all kinds of ways. And there's no other way it would be. And we just have to make sure that competition doesn't get us to a point where we don't realize that the best world is one in which both the United States and China prosper. I mean, we do not want to have an island of prosperity in the rest of the world, envious of us in a nuclear age. And China doesn't, Russia doesn't. I mean, we all recognize the dangers of letting competition get out of control and become. You can be competitors without being enemies, and that's what all powerful nations have to realize over time. I mean, it's different than 200 years ago when you could have some dominant country, and then they may have done some things that you didn't like, but it didn't threaten the existence of the world. You really threaten the existence of the world as we know it if important countries do not constantly recognize that they can compete, they can fight over certain things, but they can't regard it as essentially the equivalent of war.
Here's a question from Kevin Chen, who is a Berkshire shareholder and an NYU professor. And he says, and this is sort of along the lines of what you were just saying, Warren, but do you think that U.S. and China will be able to resolve their differences, or are conflicts unavoidable?
Well, I don't think conflicts are unavoidable, but I think it has to be active thinking on the part of every hugely powerful country. And Russia is hugely powerful. I mean, 90% of the nuclear arms in the world are between U.S. and Russia. So they have to recognize that the best world for them is one where they don't try and grab all the apples, basically. And we have to recognize that. And we can't, in the United States, we can't think that either our ideas run the world, or we start getting aggressive about things, and China can't think that, and Russia can't think that. And that's obvious. You just have to make things, you got to be sure things don't escalate. You have World War I, with an archduke, I mean, you get these, you can get chance incidents, and you really want to, I asked one of the presidents one time, in terms of what he would do if he awakened in the middle of the night with somebody coming to him and saying, absolutely, somebody else has launched, and would you launch on that? And you've got 10 minutes to decide. And I wouldn't want to have that responsibility, but you want to make sure you don't get to that point.
Right. Would you ever make a big acquisition in China? And if not, aren't you missing a huge portion of the world?
The answer is we would. Yeah, we would.
Have you looked?
We've been made aware of some things, yeah.
Are you concerned, on the flip side of the coin, are you concerned that the rule of law is different, that the accounting might be opaque?
Well, I'd want to be sure I understood the accounting, obviously. In some businesses, that'd be easier to do than others. But I know the laws, the customs, the accounting, the people better in the United States than any place else. So there's some small hurdle in many countries to get over, which I can get over. I mean, but I just don't. It's just not as easy as looking at something where I already know the answer, from previous transactions or something of the sort. So it's easier to make a big acquisition in the United States. I have to do more work if I'm looking beyond the borders. But I love the idea of doing it. When we made the acquisition in Israel a dozen years ago, I didn't know what the tax rates were there. I didn't know what corporate law. I suspected that it would all be answered satisfactorily, which it was, but I didn't just automatically know it.
It seems like you're more open about doing a deal in China than in previous conversations.
I don't think so.
No?
It's out there. I'm open. Yeah,
Right.
we made 2 decent-sized stock acquisitions there, and they worked out fine.
Those are?
Well, PetroChina and BYD.
BYD, yes.
Yeah, BYD was Charlie's, but
Right.
Charlie's
Yeah.
very well versed on China.
Right. The U.S. trade deficit has been widening, and of course, a lot of that has to do with our trade with China. Is that something that worries you?
Well, I wrote an article about it for Fortune and the trade situation many years ago, and when our deficit got to be large in relation to GDP. I don't think it's essential to have a trade balance, but I think that if a trade deficit gets large and it looks like you have no way out from it, that can be a real problem over time. I mean, you're shipping little pieces of paper to the rest of the world, and they're shipping you goods. I mean, people are working, making underwear or shoes someplace, and they get little pieces of paper from us. And it gets very tempting if you've done that enough to make sure that those little pieces of paper aren't worth very much over time when they want to cash them for something. So you don't want to have, we don't have any problem running trade deficits, but if we ran really large ones and we sort of worked ourselves into a box where we didn't really have a solution to get the numbers down, it could be a problem. And I wrote about it one time, but it's kind of a nice thing, actually. Just, I mean, wouldn't you like to have something where you just send out little pieces of paper and somebody keep supplying you with your food or your, whatever.
I'm living it.
You're all, right? Yeah, right, exactly. Yeah, we call them credit cards in the United States.
Exactly. Yes. Okay. And last question. China is facing its slowest growth in nearly 3 decades. The leadership there lowered the targets, I think, to around 6.5%, 6%. Are you concerned about this slowing growth and the impact on global markets?
Well, I don't worry about it in terms of global markets. I mean, China's going to grow a lot over time. I mean, when you think of what's happened, well, this is 1949 or whatever, but there's been nothing really like it. I mean, you had 20% of the world's population at that time, perhaps, really hadn't remotely achieve their potential. I mean, they had the intellectual capacity, they had a decent soil, all kinds of things. I mean, and what's happened there almost is beyond belief. And that game's not over, but we've had incredible developments in the United States. I mean, real GDP per capita is 6 times what it was the day I was born in the United States. 6 times. And we thought we were a pretty developed country then and everything. No, my parents wouldn't have believed it. I mean, they would have thought, that this kid has really got it made. I make more in the United States, and it was true. I mean, we had this tailwind, and China's had a hurricane behind it, in recent decades.
In a good way.
Absolutely.
Because you were comparing it to the tailwind of the hurricane at your back.
At their back, and they have found a way of life that is dramatically different than existed for the billion. There was a billion then, maybe a billion, 2 or 3, whatever it is now, and they have changed a country really of size that's, I don't think there's ever been anything like it. We've done it too, but it took somewhat longer. I mean, it was more stretched out. It was a remarkable period, but when you go to, I first went there in 1995, and then they regarded it as a miracle, and then I went back 10 years later, and it was a whole different country beyond that.
Warren Buffett, thanks so much for joining us. I'm Andy Serwer. You've been watching Influencers. We'll see you next time.